Good evening, everyone. Welcome, welcome. Let's start with the Pledge of Allegiance.
I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Good evening, everyone. Welcome, welcome. Before we get to tonight's agenda, somewhere in the agenda tonight, I'm going to ask, probably towards the end, Catherine to go over the parade so we can get an idea of who's going to participate in that and a few other things that are going on. But I'll push that to the end right now and we'll begin. So that brings us to item number 2, routine applications. Mr. Drake.
We have 2 routine applications tonight. One is PD1 for the police department, $27,200, approval to use funds from the speed enforcement program. And the second one is HD2 in the health department, $45,377, approval to use a grant that was earned by that department.
The items are moved. Do I have a second?
That's second.
Okay, these are our routine applications. Discussion? All those in favor?
Aye.
Opposed? Abstaining? That vote is 12-0-0. That brings us to our non-routine applications. Excuse me. PR1, Mr. Johnson.
Thank you, Mr. Chairman. I would like to move PR1, Parks and Rec, $48,000 additional appropriation to replace the Island Beach generator.
That item has been moved. Do I have a second?
Second.
Second by Mr. Raymer. Committee reports?
The Budget Committee met with Joe Siciliano, Tom Greco, and Jeff Freitag from the Parks and Rec Department. They talked about the 20-year-old generator, 35-kilowatt generator, had been held together with Band-Aids over the last several years and finally went out during the month of August, the height of the season of the beach. This generator was the primary source of power to the island. So what they would like to do is ask for an additional appropriation to purchase a new generator to have it ready to go before the fiscal year 16 ends. That's why it's an additional appropriation. Roughly, it's a $34,000 cost for the generator, and additional money needed for rentals, as well as switches and circuits and all that to get it ready. The Budget Committee voted 4-0 to approve this item.
Discussion on this item? All those in favor?
Aye.
Opposed? Abstaining? That item is carried, 12-0-0. PR2?
Mr. Chairman, I'd like to move PR2 for Parks and Recreation, $15,000 additional appropriation to replace a steel workboat.
PR2 has been moved. Do I have a second?
Second.
Okay, committee report?
The committee heard from the same people from Parks and Rec. Originally in 2014, funds were made available for buying a used workboat. And this boat does everything from move docks, carry equipment around, break ice, what have you during the full year. They looked actively for a used boat on the used boat market for the last 2 years, could not find something that met their specs. So they'd like an additional $15,000 to increase their budget from $45,000 to $60,000, which includes an engine as well as the boat, in order for them to buy a new boat. They have already identified what they'd like to buy and what the price is. So the committee voted 4-0 to approve the additional appropriation.
Discussion? All those in favor?
Aye.
Opposed? Abstaining? That item is carried, 12-0-0. Mr. Johnson?
Mr. Chairman, I'd like to move PW1, Department of Public Works, $1.6 million, release of conditions for the Byron Pool Master Plan construction project.
I believe it's $1,450,000.
I'm sorry, wrote that down wrong. Thank you, Mr. Raymer. $1.45 million.
Seconded by Ms. Tarkington. Committee report?
I'd like to read, if I can, the conditions that we placed. It was for an amount up to $1.6 million upon review and approval of plans and contractor bids for remediation, site work, and demolition of existing buildings and structures. The committee heard from Alan Manelli as well as Amy Siebert. A number of bids, I think in our package you saw the extensive list of bidders, were received, well below the $1.6 million budget that we had initially allocated. We did review the work and the schedule for this, and again, this has to do with the remediation of the soil itself, as well as the structures, meaning the old pool, the pump house, and a couple other structures for demolition. We were gratified to see that the bids came in below what we had asked for. I do compliment the hard work of Alan Manelli and his group for finding the different appropriate bidders as well as their timelines and schedules. I will say, just for clarification, that again, this is for soil remediation and demolition of the structures. We will be meeting again with DPW to talk more about the next release of funds, which has to do with refined cost estimates for the construction of the new pool and facilities, as well as some options to lower the cost based on our request during the budget hearings last spring. Anyway, having said that, the Budget Committee voted 4-0 to allocate $1.4 million.
1.450.
I'll get this right. $1.45 million.
Okay, discussion on the item. Mr. Raymer.
Yeah, I just want to be sure, because I know that the press is present, I just want to be sure that there isn't some misunderstanding out in the public perception. The original $1.6 million was a very early stage figure prognosticated by Alan Manelli before he had an awful lot of basic input, and he, by his own admission at the time, was making an assumption that that figure is probably on the generous side. So I don't want anybody to have an impression that there's cuts being made or anything of that sort. The bid that we have before us, the successful bid or the low bid, appears to be $1,162,000. There is another $40,000 or so of development costs that need to be done on our side for a total of $1,202,000. When we take that number and add a contingency, a fairly generous contingency of 20%, that gets you to roughly the $1,450,000 that we're approving. So what's happening here is not that we're cutting anything. What's happening here is, on the contrary, we would be appropriating or releasing actually funds to fill the full measure of the bid that's before us, plus the $40,000 of additional work and 20% contingency on the whole package, including the $40,000. So it's meant to be actually a generous process of stepping forward and releasing funds in the full measure of what's being asked to move this project forward. Thank you, Mr. Chairman.
Further discussion? I have one thing. Roland, if you would, maybe before Elaine goes away, I'd like to email to the RTM the blue form, even though it's white, the bids and the 5 drawings that go with this to the RTM. As you know, this was a non-standard. The RTM, we had asked the RTM not just to approve the A&E in the first year and the projects later on, as we got that information back, in order to not have a closure for so long. So I want to keep to sort of the conversations we had. So I just want to email this out, and I plan on doing this. And by the way, for the people who didn't get this information in our package, you can see on the date of the Budget Committee is when the bids came in. So Al had not had his spreadsheet built up yet because he was coming to our meeting. So I just think we want to have good distribution on that. So if you would do that for me. Okay, further? All those in favor?
Aye.
Opposed? That item is carried 12-0-0. Moving on, Assessor's Report.
Good evening. Good evening, Mr. Chairman, fellow members of the BET. I'd like to present the Assessor's Report for September 2015. Before I get to the 2015 reval, just a couple of quick updates. First of all, personal property declarations are been sent out to all businesses. They are due back by November 2nd. as November 1st is a Sunday this year. And I'm happy to report that the Board of Assessment Appeals held their hearings. They only had 56 appeals, and they reduced our grand list by $346,470, which is roughly, it's less than $4,000 in taxes, so no great impact there. As to the 2015 revaluation, okay, we are currently reviewing mostly the residential assessments that the revaluation companies have handed back to us. Right now, we are on track to send out notices probably in mid-November. With that said, we are going to be asking for an additional 1-month extension. I believe the assessor's office in the past has asked for that, and we're going to do this. We're going to ask for it as well this year. We're going to ask for it because I think we're going to try and have at least up to 8 weeks of what we call informal hearings. So after we send out the notices in mid-November, we're going to have a number of weeks where people can come in and talk to the revaluation companies, the commercial and residential companies, and go over their assessments. Our philosophy here is the more people we get in on the informal hearings, hopefully the less people will be going to the Board of Assessment Appeals. When we get the 1-month extension, that means the appeals to the Board of Assessment Appeals will be not due until March 20th, and then the appeals won't be happening until the month of April. So with that in mind, it's kind of important, I think, if we can alleviate as many hearings to the BAA as we possibly can. Okay. Any questions?
Ms. Tarkington?
Yeah, I would just like to add to the comments that Lauren has provided us. In the past 3 revaluations, the town has requested this extension. It's requested by our first selectman, and it's considered routine. And the approval for the 3 times it has been requested has been by approval of the monthly letter. We did, Lauren and Bob did go back and confirm that. Bill and I have been meeting with Lauren and Bob and other people in the department approximately every 2 weeks on the reval. And we've met recently with the residential evaluator, and the reviews are continuing by section of town. The neighborhoods of the past revaluations have been modestly changed, and that's to reflect consistent zoning. There's been much focus on zoning in this. And finally, in August, the assistant assessor position has been removed from LIUNA, the LIUNA Union, and the position is now an MC position, which is needed for this department. And Bob Shipman is in that position, and he has acted as the assessor for 2 different searches. So he has a lot of experience in this area, and with a portfolio the size of ours, it's important that we have a strong management team. So Bob has really, I guess, gotten a promotion, and we should applaud him. And I believe this is going to be backdated to July, but,
Yes.
We've been advised by HR that this has been finished, completed.
Anyone else?
Yes, Mike, I'd like to.
Mr. Norton?
I'll make my usual reference to the
Yes.
pending court cases, and it looks as though the courts took the summer off.
Yes, they did. Yes. I do not take them off that count until we've gone through the painful process of getting the final stipulation of judgment from the court. So not until we are totally off the hook do I then take them off. But we have some that are ready to come off, let's just say that.
Same number we had in July. so-
Yep, yep.
So I move we approve the assessor's report?
I just
Oh, I'm
have,
sorry.
if I may, so you're asking us to give a 1-month extension, so procedurally, do we need to formally take a vote on that? I would think we
Do
would.
it now, or do we?
I would think we would, item 2 on the report under evaluation, it says you're requesting a 1-month extension to complete the 2015 grand list once approval is given by the BET. I think that's what we're being asked to do here.
Well, again, in the past, it's always been by approval of the assessor's monthly report, but if you want to approve it separately, we can go ahead and do that. Is that what you'd like to do?
Is there,
I would like to do that.
Okay, so I move that we approve requesting a 30-day extension to complete the 2015 grand list.
Second.
discussion on a motion? All those in favor?
Aye.
Opposed? Abstaining?
Excuse me, Mr. Chairman.
Oh,
Just,
sorry.
Thank you. Oops.
weren't we told that the first selectman would issue a letter? And so it's not,
Here's,
Up to the BET?
I ask, well, because you're a bit different than most municipalities, I usually.
Special.
Yes, ton of Greenwich. Usually I ask directly, because I report to the selectmen.
Yep.
The Board of, the Board of Selectmen to grant me an extension for 1 month. The selectmen then grant it, and then they notify OPM that we've asked for, and that he's granted it. Because I report to you folks, it makes it a little bit different here.
Right.
Yeah.
excuse me, Mr. Chairman,
I think we're still following our position.
Yeah.
and the last 2 or 3 times this was done, was it a vote? Because I thought
I think what they're saying here, Mr. Goldrick, is that by approving the assessor's report, that gave it the approval
in the past.
in the past. So I think we're
Think
just
it
taking an extra formality, but it's
yes.
fine. So all those in favor? Aye. Opposed? Abstaining? That motion's carried.
Thank you.
Thank you so much.
See you in October.
Brings us to the Controller's report. Hello, Mr. Menarski.
Good evening, Mr. Chairman, BET members. I'll start with the front page, an update on the ADP. As stated, it's amazing that a year is just about gone by. We went live last October 17th, and we've reported periodically the problems we've had. And we reported that we've brought in Barry Dunn, and we brought in Geneva Consultant to help us. One of the things we also did was we created a steering committee, which is headed by Peter Tessie and Dr. McCursey. And more importantly, to get more hands-on and more proactive, we've created a steering subcommittee. And the steering subcommittee consists of Mary Pepe, Ben Branyan, myself, Tom Klein, Al Cava, and the consultant, who's now Becky McAvoy. She replaced Tamara from previous months. And listed in the report here is just the general areas that we have concerns. I've expanded it a little bit because in the past, at the request of the 2 liaisons, Nancy and Mary Lee, we wanted to concentrate on the general ledger reconciliation and the treasurer's reconciliation. Happy to report that one of the topics, one of the areas is the general ledger reconciliation, and we've gone to a different option. I'm not going to get into the technical details. Nancy and Mary Lee are aware of them. And Becky has reported to me as recently as this afternoon that it's greatly improved the general ledger reconciliation process. And what's left is just small tweaks. Every payroll, just like we had with Munis over the years, things fall out. There's unusual events that may happen where every once in a while something's going to pop out of the general ledger reconciliation. So we're doing well there, and we'll get a further update tomorrow. I don't have a complete update for Nancy and Mary Lee because one of the issues was we had one of the major players beside the consultant and Roland was a Board of Ed, a person that was out sick, so we had a slight delay, and I'll give them an update. The other areas are full utilization of the system, training, and time clocks. The consultant reports to the steering committee on a weekly basis, and by full utilization, we have issues, and they're tied somewhat to the time clocks. We've got people out in the beach, the beach areas, the park areas, and we don't have a complete deployment of time clocks. And so occasionally, they'll use the timesheets. which is coming up as an exception in the assessment of the overall. We're trying to get 100% away from timesheets, but in certain instances, we've got people who just don't have access to a time clock. So there's a shortage of time clocks in a couple areas that have been identified by the consultant. I think the Board of Education asked for 17 of them, which they're basically not going to get because they don't need 17. But they do need some in certain areas. And then there's areas out there in certain sheds that don't have connectivity, et cetera. So that's one of the issues is we're addressing is trying to get the right number of time clocks. And backing up to the full utilization, we still have the resistance in pockets that are being addressed where people are afraid to use the system 100%. And we're addressing that through the steering committee, not the subcommittee. And we've got to get the people off of the timesheets and rely on the time clocks and get our money's worth as far as utilizing this ADP system. And then the last one is the training. The training is really very important. When I say training, getting the managers trained so they can fully utilize the ADP system so they can print out manager reports. There's still areas where they need to have trained. Unfortunately, other priorities have bumped the training to the end. We want a payroll in a timely manner. We want an accurate payroll. We've got GL issues that you remember from last year where the departments have to rely on it so they know where they stand so they can come to the BET and the RTM in a timely manner. So, again, we have a subcommittee, the steering committee that meets weekly. We're very hands-on, and as the issues arise, we address them. And I have one more point, but I'm going to recognize Nancy. I think it's going to.
I just wanted to acknowledge the huge amount of work that finance, HR, IT, and the Board of Ed invested in this to get us to where we were. When we think of where we started in October and went live, and the multiple problems and the complexities, particularly given the culture of our town, I think it's a huge undertaking and success. I think another important point in what the consultant has been working on is that now that we have the system, payroll is working to make sure that the people who are managing the town in terms of their payroll and their department have access to the information. And I think that's one of the things that the consultant has working on and is showing some signs of success in being able to produce the management information reports, which will allow us to get more value and information out of this system.
Ms. Kieran?
Pete, I just had a quick question. I don't think we've touched on this for a while, or maybe you're about to, and I apologize if I'm preempting you, but with the audit going on, do you have any sense of whether this is going to be an issue? That we certainly all acknowledge we had a couple hitches with implementation, but can you share any sense of whether that's going to be an issue for
Yes,
auditors?
I can. As a matter of fact, that was going to be the second part. I was going to shift to the auditors and Kathleen, but I saw Nancy's hand go up, and I didn't want to drift out of this area first. Auditors last, but one of the biggest concern was the June 30th bank reconciliation I reported 6 months ago was my biggest concern, and I'm glad to report that it's reconciled. You can see in here it's down to $576, which is basically reconciled, because I was concerned that it would generate a management letter comment, okay? So as far as Kathleen, she's reconciled with the June. I mentioned the July and the August with larger numbers there, but we're still, our priorities are the audit and getting it finished. We're going to get that down and reconciled, and it's premature for August. As far as the work, Kathleen and Roland have been spending a lot of time over the last 10 months or so making sure everything is posted in the general ledgers. And the check and balance is Kathleen, who handles the cash. And Roland and Kathleen have been many months. Kathleen will come over and say, we're out of balance by $2 million or $1.2 million or something like that. And they'll go through and they'll find out that certain things were not being picked up in the general ledger and the cash, to reconcile the cash. The audit. I spoke, the auditors starting their field work, aside from their the field work, the preliminary work, they've come back on the 21st, which is Monday. I spoke to the partner, I'm sorry, the manager, and they did a test of 5 payroll employees. They came up with exceptions, and they've expanded to answer Mary Lee's question, the testing to 45 payroll employees. I don't know what the exceptions are. They haven't told me. I really haven't asked. I'm more interested in the 45. If the 45 payrolls that they're testing comes up with an unacceptable number, they're going to call a timeout. They're going to approach the audit committee led by Mr. Norton, and they're going to expand the audit in that area, which could be translating into more dollars. I don't want to be an alarmist. I have no feel for where that's leading. It might simply go away. I don't know what that's going to lead to, but the potential there is they could expand the audit of the payroll area. Where I have a concern is that you're auditing in implementation. Every implementation in the world has speed bumps. You're going through a learning curve. You're going to find exceptions. They're auditing files that are going to have errors in them. It's called implementation. I would have preferred if they concentrated a little bit more when we got through a lot of the bugs out. So the answer to your question is there's a potential there that if the 45 files that are tested have more exceptions, they could expand the scope of the, this is the annual audit. Right. And I'll report back to you. Of course, Mr. Norton's going to be notified first in either the month of October or November, because we have that going back to the first paragraph in the controller's report. We've got to have a draft audit done by November and have a full audit, single state audit, a state and federal single audit, and a management letter to the BET by December. I'll open it up to any other questions or any payroll questions at this point for the controller's report.
We have a motion to accept the controller's report. All those in favor? Opposed? Abstaining? Thank you. Moving on to item 5. Mr. Norton, do you have a motion for the treasurer's report?
So moved, Mr. Chairman.
Discussion? All those in favor of acceptance of the treasurer's report?
Aye.
Opposed? Abstaining? That item is carried, 12-0. BET Standing Committee reports. I believe you have an investment committee report that's been sent to you. Don't have anything else there. I think,
Mr. Chairman?
Mr. Raymer.
Sorry to interject. It will be addressed when we're looking at the investments under item 9. But there's a slight misstatement by the Investment Advisory Committee notes that reflects on prior approvals of certain levels of investment by the Law Committee, indicating the Law Committee had already approved those levels of investment. And that's actually not the case. But I'll speak to it more when we look at these items a little later.
Thank you very much. Item 7, liaison. I haven't seen a schedule yet for the CIP committee or process. I know there's been lots of conversation about that. When I get that, I normally would ask a couple members to see if they can stay with that. What I'll do is I'll put out the schedule. Certainly, I think, oh, yes, if you would, because we're on that. Good evening.
Timed your arrival perfectly.
I just had the opportunity to be at the YWCA Spirit Awards, where they're recognizing 9 wonderful women for their contributions to our community, as you all contribute. CIP process. As you know, we're in the transitional period with BET members serving and those who will be joining the board over the next 3 months. So we're trying to do our best to bring forth information to some of the new members. You may not know, but last Friday we did host a meeting for the incoming members to specifically share with them information on fire services, and we will continue to do that on any other issues. The CIP process is certainly one that's driven by the executive branch of the government. That is per the charter provisions that were enacted in 2004 after referendum. The process that was established by Mr. Lash when he was first selectman and I was chairman of the BET is one that we continue to follow, although in a modified form. It is a discretionary process, meaning it doesn't, someone can come in, a new person can be elected on November 3rd and say, you know what, I'm not going to do it that way. I'm going to sit down with department heads. The Board of Ed is going to sit down with their board and professional staff, and we're going to put together our 15-year plan, and we're going to submit it. And we're not going to have a ranking process. That is not what I intend to do if I'm elected again on November 3rd. My intent is to work with the new town administrator to refine the existing 15-year capital plan, first and foremost. That is the point of departure by which we're going to be looking at subsequent years. It would be foolhardy to just throw it aside when we've all worked so hard to build off that document. So number one, we're going to use that as the point of departure. We have indicated clearly to department heads to look carefully at those projects that are already been committed to and give clear reason where they stand in the regulatory process. If there's delays, what are the delays? What is holding up the movement of it? Once they've done that, then certainly they're going to look at the items that are in the 16-17 line that were there in this current year's budget and evaluate whether they're going to bring those forward based upon that earlier analysis. Once they do that, we'll be sitting down and following what I thought was a very good process is what is a recurring maintenance program? What is it that we do every year that we've committed to do that has a natural assessment to it? Paving is one, vehicles is another, roofs and so forth, and group those as maintenance. Then look at things that are replacement. Certainly capital equipment, there's some variability there, but there should be data from the fleet director that will allow us to see its useful life. And then there are what I would call discretionary items, things that we may desire to do, but they don't have to be done within that particular fiscal year. And I think those are the areas of focus and concentration for a ranking process that will use the same criteria that has been used the last however many years it's been. I have to do my math here, 12 years. So in terms of involvement, I continue to seek people from the RTM, the BET, and the Board of Ed. I think it's extremely valuable to have them at the table as we discuss these projects. It acts as the foundation for which we build on that you ultimately get the budget in February. So certainly whomever you want to designate for that process. Again, we are in a transitional period. I'm someone who does not like to be presumptuous, but so long as I have the responsibilities through November 30th, I'm going to follow it through to that date. We'll see what happens on November 3rd. But I know there's 8 of you are going to be here, if I did my math right. 8 of you are definitely here, so I hope that answers your question. I hope it wasn't too much. But if there's something you'd like to suggest, please do so. I know Mr. Branyan is reaching out to departments, meeting with departments. He certainly would like to hear from any, if not all of you. He's done that autonomously, meaning on his own accord. Certainly, I bless what he's doing, but I think it's a healthy sign because he's giving people an opportunity to provide their perspective to him as he helps organize this capital process. So,
Mr. Chairman.
Mr. Goldberg?
Mr. Tessie, a year ago, Mr. Huffman and I actually went through that exercise of taking what has to be expended in terms of paving, regular maintenance, school maintenance, and so on, and coming up with a baseline of expenditures in the areas of that. We did that with our finance department. Mr. Geiger has a copy of that spreadsheet, and I'm sure he can send it to you, and will save you all, and your staff a lot of time by going through that, because we've already vetted this over a period of weeks, and I think that sorting process, you'll find, has already been done there.
well, thank you. I know that we did it as well in terms of relying upon the departments. Again, I think we all share the same level of confidence in the departmental managers that we have, both in the financial sector as well as in the departmental administration. And so they're telling us, based upon their day-to-day operations, what they think they need. Obviously, we're the fiduciaries. We have to make a determination if that fits into the overall financing scheme and allocations that we so choose as part of our judgment. As I say, we make a series of judgments in our respective roles. I will make mine. I'm here, you will make yours. And that ultimately winds up being the town's budget with the RTM's blessing. So certainly appreciate your efforts as well as always and others, and we'll work as we always have done with Roland and Peter and Ben. And Melissa, let's not leave Melissa. She's been doing some good work on the budget prep as well. So any suggestions you have, our door is open, Ben's door is open, and just let us know. And again, thank you.
No, thank you, Peter. Item 8, special project team reports, labor contracts. You want to?
It's a little soon for us to talk about the GOSA negotiation from the summer, because this will be considered, I believe, by the Board of Education this evening and then go to the RTM for their October call. So perhaps at the next meeting, we can report out on that.
I think that that contract settled about 20 minutes as arbitration was scheduled. There was some, that'll be a unique contract settlement when that gets, I see Mr. Wasik here for Chairman of Finance. So, I'm sorry, Mike Hornick, I'm sorry, I do that all the time. So there'll be a report on that, but a lot of time went into that one. We did a mediation session till about 3:30 in the morning, and then we tried it again a week later and went till, it was certainly after midnight. So we put a lot of work into that one. Parsonage Cottage. It is my opinion that the auditor is getting close with all of the gatherings. Peter, just help me out on this so we're accurate. And our goal, just so the board knows, I think we should try to have a goal of disposing of their item in October, because if we do take an action of one of their requests, I think it has to go to the RTM, which they don't meet in November. So that's sort of my goal if I can, but
Ms. Karen and I had a extended conversation on the with the auditor, Jen Mazzacolo, who's in charge of this assignment, and they're basically done. And from our conversation, and correct me if I'm wrong, there's one open item that we need to go back. One of the requests that we had was to verify the income eligibility of the 40 residents at Parsonage. They did a sample of 5 in 2011, 5 in 2012, 5 in 2013. It was agreed to go back and do all 40 in 1 year. That, I believe, is the only open item, and it's really the use of the word audit might be overplayed a little bit. We like to call it an operational review, or Ms. Kiernan refers to it as a due diligence review.
Yeah.
So when that final item is closed out, they've already written a report in draft form, but we tried to clean it up. We had outstanding questions, so it's basically done with that one set of testing. And just to follow up to Mr. Raymer's question last July, I think you asked this question. The 2014s, the answer to the question was, why is the 2014s in the request? It was the timing. It just, when we did the request back in the winter, the year had just closed, and they have an obligation per the operating lease to give me their 2014s without me even asking. And the answer to the question is, aside from me asking or not why it's not in the audit, it was the timing. And number two, the 2014s is still not ready. So they're not going to be available. And I can't promise you because I don't know when they sign off on them. So the 2014 financials for the Town Hall, Annis Corp. In Parsonage, as of last week, I haven't checked this week, we're not ready. Audited, I mean.
I guess my point is, we have a working committee on this, and I just want to see if we can sort of wrap this up and get it to the
I
RTM
believe-
before their term ends?
I believe the goal is to try to get this no later than the BET approval in November. If you all remember, going back a few years, they wanted a loan forgiveness. It turned into a loan modification on the 2 loans. It would be ideal to try to get it in for the BET in November and the RTM in December, because one of the key players in the group, Bill, will be leaving and falling off after the December
And
meeting.
Mark?
That's correct, and the 2 of the 4 working group members. So that, and I think we can get this hopefully on the agenda for October, November, and then to the RTM for December.
Thank you. Thank you so much. MISA Building Committee, I believe we had a report.
No, we didn't
sorry.
have a report. I think, I'm happy to report on September 15th, the music students moved into their new temporary space in the completed MISA area, which would include the stage, the ancillary rooms like the green room and the costume room, et cetera, are becoming temporary classrooms. We're busy now completing the TCO on the last remaining area, which is the auditorium seating area and the hydraulic thrust stage, and also simultaneously working on all the approvals, which mostly come from Hartford, in order to proceed with the demolition of the existing auditorium and the, old classroom space. And the combined projects are called Phases 2 and 3. So it's a very busy transition time at this point in time. But it's people are thrilled with the success so far, and looking forward to use of the building this fall.
Okay, that brings us to item 9. Approval of
Mr.
proposed-
Chairman?
Oh, Mr.
I wonder if we could have an update on the ad hoc committee on the school lunch revolving fund.
I didn't receive one. Mr. Blankley, do you have anything on that?
The matter is before the Board of Ed this evening, Mr. Chairman, and therefore it would be premature to speak before the Board of Ed has opined.
Okay, so they have that on their agenda tonight. Okay. Mr.
Well,
Johnson?
Mr. Chairman, maybe,
If I could just also add that we plan to discuss that as an item on the agenda for our regular Budget Committee meeting on October 13th. Get an update from them. They weren't ready for this past Budget Committee meeting because they had not gotten approval from the Board of Ed with their results. So we'll review it on October 13th.
well, if I may, I think what I have gleaned from this, because I asked for an update in July and was told they hadn't met yet. In fact, this committee had met 6 times by then. It had received a report from a consultant, which Dr. McCursey said was dealing with the challenges facing public school districts' food services. In fact, it was solely regarding outsourcing of the school food services. And I asked for a copy of this, and in fact, I was denied. In fact, on June 29th, they voted to withhold this information, and I think that was rather sad. I had to FOIA this. But the long and the short of it was that this report concluded that this outsourcing is very controversial. It involves loss of union jobs.
You have this report?
Yeah, I FOIA'd it, yes.
Okay. The Board of Ed hasn't approved it yet?
It is going before the Board of Ed, but I figured since we have a representative on the BET and from the BET, we should discuss it ourselves here.
Mr. Chairman,
Mr. Finger?
I mean, all due respect, I think if this is in the bailiwick of the Board of Ed, this is within the bailiwick of the Board of Ed. It's their committee, and if they're going to be voting on it, presumably tonight, or at least discussing it, I think we should probably hold off and see what they conclude, because regardless of what the reports were, ultimately the Board of Ed is the body that makes the recommendation. So I think it's premature for anybody to speculate.
Right. I'd rather have the report so I can read it before I can discuss it. I can't. I don't have that. But, so we're on for next month with that, Mr. Blankley?
I think just as a matter of principle, if you have a representative from this board on a committee, that's what these whole items are about, reporting back about these committees or special committees and so on, and we should be kept informed. So I'm
I think
prepared
he
to
did
go
inform us. He told us this is in front of the Board of Ed tonight.
Yeah, okay, let's continue. Item 9, approval of the proposed side letter. I think that's Mr. Raymer first.
Yeah, because I'm not sure that the Investment Advisory Committee acted on this letter. I think you're going to find this is pretty straightforward. We approved the investment in Landmark Real Estate Fund 7 back at the November 2014 meeting. It was approved for $15 million. The documents at that time had one of these quite common side letters that Attorney McLaughlin is careful to draft and include. It's one of these most favored nation status letters, the gist of it being that if the fund grants special conditions or privileges in agreements with other investors of the same class of which we are, that the fund will then offer to us that we may graft into our agreement, if we wish, those same provisions. I don't know if I articulated that clearly or not. In any event, Jean received such advice from the fund that they have, in fact, granted certain provisions to certain other investors. He reviewed them. In this particular case, in his opinion, several of them were useful, positive to the town to graft into our agreement. Gene has laid those out in his letter of September 3rd, 2015. It was a letter to Mrs. Tarkington and myself, but copies of that letter were included in your package. I won't pretend to go through each of the items there before you. Again, I think they're fairly straightforward. We as a law committee voted 2-0 to approve these changes to the agreement as being in legal order.
Okay. Mr. Drake, did you committee review this?
No, our committee didn't,
Okay,
as Mr. Raymer said.
okay. Discussion on the item?
So I move, Mr. Chairman, I move that the BET approve these changes to the agreement as set forth in Mr. McLaughlin's letter.
And I second that motion.
Okay, discussion, yeah, it was in the package.
It was sent separately.
Separate, yeah, but,
Oh, sorry.
okay, discussion? All those in favor? Aye. Opposed? Abstaining? That item is carried. Approval of the GAM unconstraint. I'll call on Mr. Drake on the next item.
It seems when I push my mic, somebody else on, I'm not talking? Hello, is that better? We'll do it without the mic. Thank you, Mr. Chairman. Let me introduce this topic. We have Mr. Chadwick here as the head of the retirement board, but in today's low interest rate environment, fixed income investing is a challenge, and everybody in the markets anticipate that rates will rise, which will make it even more challenging. And so the retirement board is looking ahead and doing a proper job of predicting what's coming and positioning the fund for these events, which are likely to come, but we don't know when. So there are 3 different funds, which will be 3 different motions tonight, but they fall in a category. One is the new fund of the GAM unconstrained, and the other, Loomis Sales Senior Loan Fund and Loomis Sales Strategic Alpha, are funds that have previously been approved in which we have investments already, where the idea was to raise the limit, which would allow the retirement board to make the technical allocations that are their duty. So in our meeting in the Investment Advisory Committee on September 10th, we voted 4-0 to approve these 3 items: the GAM unconstrained bond fund, and to increase the maximum investment amount in the Loomis Sales Senior Loan Fund and the Strategic Alpha Fund. So that was the action of our committee. And So I'd like to invite Mr. Chadwick to comment on the motivation of the retirement board and what they're trying to achieve here.
It's not a question if interest rates are going to rise, it's only a question of when. And we have begun to take steps, and have been doing it for many months now, to alter the portfolio, to shorten up our bond portfolio, and to add more money into short-term fixed income investments. At the meeting a month ago, we thought that we would add some more money to the Loomis Sayles Strategic Alpha Fund. And Mr. Minarski said, well, you can't do that because you've already reached the limit for what you told the BET it would be. We talked about that, and I think that it is a real constraint to have to, it's more than, it is it's a waste of your time to have us come in here every time we want to change the amount of money that we're committing to one of these funds. It's also a waste of the law committee's time, and it's a waste of the investment committee's time, and more importantly, it takes time, and time can be money, as they say. So what we initially said was, looking at our investment policy statement, why don't we say that any of these investments could be 10% of the portfolio, which is the limit under our policy statement. We kick that around. $400 million is $40 million now. And we floated that as well. And I think in discussions that took place in both the Law Committee and the Investment Committee, $40 million was a better number than 10%, even though I believe over time this fund will grow, and we may want to come back at some other date to change that. And that is the genesis of how we got to this number.
Ms. Weisberg?
Mr. Chadwick, can you comment, I'm looking at your investment policy, is both GAM and Loomis Sayles Strategic included in the Global Fixed Income Manager category in that policy?
I think I know where you're going with this, which is that outside...
I raised questions previously anyways with Larry Simon, and I think you were copied, so hopefully you do know where I'm going.
Outside counsel recommended some additional words for our
I didn't see that counsel. Yeah.
Investment policy statement, and what he came up with I thought was a pretty good idea.
Could you clarify that then? I haven't seen that, or at least had the chance to see it. I guess the issue I was raising, I'm looking on the policy here, and it's saying the overall average quality of this portfolio should be A or higher, and if you look at Loomis Sayles, it doesn't meet that criteria.
GAM is a AA portfolio.
Pardon me?
GAM is a AA portfolio.
It's a single A.
I have their material right here, AA.
I have the spreadsheet.
I have it too.
Okay.
AA when they came in, but...
Right, it was single A now.
Okay. And with Strategic Alpha, it seems to have bounced back and forth between triple B and A.
Mm-hmm.
I think that that's something that we're going to have to talk about. We're getting ready to redo the policy statement anyway. But these are not investments that people around this room typically see all the time. And they're designed specifically to try and raise the short-term rate of return without taking any long-term risk in the stock or bond markets. They use derivatives, they use hedges, they use other means to change that around. And in fact, GAM has a negative duration at this point in time. We haven't, in my opinion, really allowed for that idea in the policy statement so far, and it's just on its cycle to come back up pretty soon. And I don't remember exactly the words that the attorney came up with, but I thought they fitted in quite well with the approach that we're taking. And I'd be happy to give them to you.
Can I just ask a follow-up question? I did see, I think that one of these could invest, I guess it's GAM, in equity-linked notes, which is sort of an interesting hybrid. I'm assuming, you know, fixed income driven by the return on an equity market. I mean, how do you not know then, to the extent it has equity-linked notes, that you're not duplicating already your equity exposure in your portfolio?
I think that that is because that these are balanced out by something else that they're doing on the other side of the trade.
Mr. Raymer?
We've moved into the discussion phase, but there was a second committee, the Law Committee, that had looked at this. Maybe I should quickly make a report on that.
Please do.
No, it's all right. I mean, we segued because Mr. Drake invited Mr. Chadwick to comment, which was perfectly appropriate. But just to fill in, if I can, the Law Committee report. We met and looked at this, and we voted 2-0 to find the documents to be in legal order. There was one qualification, however. A question came up as to whether the nature of this investment met the qualifications of the 25% of our portfolio that is restricted or constrained in the kinds of investment that it can enter into. We were prepared to endorse this investment as being in legal order either way, but we wanted an opinion from town council as to whether or not, in their view, this qualified for the 25%. If they're not so willing to opine, then our approval of this as being in legal order is as in being in legal order for the 75% that is not constrained. If the town attorney is prepared to opine that it qualifies for the 25%, then we're prepared. Then our opinion is, the finding of the committee is, that's the way I should be putting it, the finding of the committee is that it's in legal order for any part of the portfolio. We've not yet received from Mr. Fox or from Mr. McLaughlin the opinion that I was inquiring into. So I think I have to ask for a constraint of this BET, that if the BET votes to approve this, I would like the constraint to be that that the BET is approving it, but not necessarily approving it as qualified for the 25% of the portfolio which is constrained, at least until such time as we have an opinion to that effect from the town attorney.
I see that as immaterial. Fund is well above 25% in fixed income at this point in time, and whether this is approved for it or not, it doesn't make any difference to us.
I'd just like to add to Mr. Raymer's report. There were actually two things that we requested. One was the opinion from Mr. McLaughlin. The second was for our outside attorney, Gary Hammersmith, to elaborate on the risks of this particular investment. And Mr. Hammersmith did send us a memo earlier this week outlining those risks. We're particularly concerned because of, so many non-U.S. countries being involved. I think this is Cayman Islands-based fund. You had Bermuda manager, you had Ireland, UK, Switzerland, et cetera. So a pretty complex organization. But we have received that memo, and it was circulated to all the BET members earlier this afternoon. So that met that part of our approval.
Mr. Chairman, one more footnote if I can. In response to Mrs. Weissler's question, I mean, it's only been a few hours, but you indicated that you hadn't yet seen or had an opportunity to review the proposed revisions to the Statement of Investment Policy by the Retirement Board. The letter from the outside counsel that was circulated with you just a few hours ago has an attachment to it, and that attachment is that revised statement. I'm not surprised that you haven't had a chance to look at it, but in the fullness of time, I just wanted you to know that that document is available to you when you get a chance to plow through the emails that came over the last couple of hours. Mr. Chairman,
yes,
I had wanted to comment, but it's not part of the Law Committee report. At the appropriate time, I would add a comment.
Okay. Are we done with committee reports? Yes. Then we'll go general discussion. Mr. Raymer, Mr. Norton, Mr. Goldrick.
Thank you, Mr. Chairman. First of all, I want to separate that the expansion of the Loomis Sales Senior Loan Fund and the Loomis Sales Strategic Alpha Fund are the next item on the agenda. I recognize the Investment Advisory Committee and the remarks of Mr. Chadwick plow them together, but I want to come to those items in due course as we pick them up. But speaking to this GAM...
Mr. Raymer, could we just do the $40 million now and move that off the table?
That's what he's doing.
It's up to the chairman how he wants to handle that. I mean,
We're on the GAM right now.
Okay. I'm just trying to take them in the order.
That's the order we have.
Okay.
Here's a ticklish thing which is frequently addressed by me, frequently addressed by Mr. Chadwick as well. There's a friction, I mean a polite friction, but there's a friction here in the process. I have no illusion that I have the skill of understanding portfolio management anywhere near the skill that Mr. Chadwick or Mr. Simon or others on the retirement board have. But nevertheless, it remains that Section 208 of our charter requires of the BET two things. It says that if you're going to entrust money to somebody else to handle the investments of it, which is what you're doing with the GAM fund, it says, first of all, that the BET shall designate that entity. It's not important to me that we designate it when it's whispered to us by Mr. Chadwick or whether or not we come up with the name. I don't think that's important. But that's our first responsibility. And our second responsibility is that we have an obligation to approve the contract. And I have never been clear in my own mind whether or not that meant that the 12 of us, most of us having less skill at portfolio management than people who are on the retirement board, whether it means that the 12 of us are supposed to look over their shoulder and kibitz the portfolio management judgments that they're making or not. I've heard Mr. Blankley articulately speak at the time of prior meetings that we really ought to be leaving the portfolio management tasks to the retirement board. That's not our job. And I'm not sure, as I read Section 208, that Mr. Blankley is wrong. I just don't want to abdicate what I think are my responsibilities. And as I looked at the GAM fund, the unconstrained bond fund, there's a number, as Mr. Chadwick could probably tell us about much better than I. There's quite a number of these unconstrained bond funds that have emerged in the last few months. They're kind of a popular item on the investment horizon, and some of the commentators have been writing articles of concern that maybe these unconstrained bond funds are not fully or properly understood by the investors. And one of the points that they make was that the character of these investments are generally, I'm going to use my words, I hope I don't upset Mr. Chadwick, but it's the nature of it is quickly moving in and out of very short-term bond maturities. Some of them are relatively high risk in an effort to try and be handling a fixed income component that begins to defeat the very low return that otherwise fixed incomes are earning. And the concern of the commentators, as I was reading it, was that the risk frames are such that although the buyers of these items will be thinking in terms of this is part of my bond portfolio, it goes into the pie chart on the fixed income arrangement, not part of the equity arrangement. The fact of the matter is that the expectation of at least of these article writers was that they think the value of this fund will actually move more like the equities and less like the bond funds, and people who are buying them to put them as part of the fixed incomes may be disappointed that it doesn't form the hedge against the market movements of the equities. When we put these funds into our 25%, the language of the charter was that the remainder, I'm quoting now, the remainder of said funds shall be invested exclusively in cash and diversified fixed income securities, and such securities shall not include any equity, real estate, tangible commodity, or private equity investment. I think the desire of the draftsman, whether we think they were clever or not, I think the desire of the draftsman was that this component of the fund should be safe and secure and kind of a ballast to protect the overall portfolio against sharp market movements of the other 75%. As a matter of fact, when they wrote this provision, the proportions were not 25% in these secure investments. The proportions were originally 75% of the portfolio in these secure investments, which was later reduced to 40%, and then in recent times we reduced it to 25%. I'm asking that you be quite careful to be continuing to consider that the judgment of these fine people who contribute their time to this portfolio management, but their judgment has been to quite a number of fairly high risk, fairly high reward investments, which only appear to qualify as fixed income investments. They don't have that ballast for which that proportion was intended, and that we are getting, in my view, my humble view, overweight in these high-risk investments. My last comment, when we had Mr. Hammersmith before us at the Law Committee, now careful, Mr. Hammersmith is an attorney. He makes his specialty reviewing the agreements on just these kinds of investments. He looks at dozens and dozens and dozens of them, but he is not a portfolio advisor. He's an attorney who's looking at legal documents. So be careful about what I'm about to say to you next. But nevertheless, I asked him, how many pension funds and the like are you looking at the documents, or what's your client base? And he said dozens of municipalities in Connecticut as well as the state funds. And then I said to him, what typically is the investment of those funds in alternative investments or other high-risk, high-reward funds? And his answer to that was, for the state, 5 to 7%. And for most of the municipalities, the same. He said a few municipalities are up in the range of 20 to 30%, but in his view, that's a level of risk. I'm reading from my notes, which was his quote. That's a level of risk which was more than should be done for a retirement account. That was his perception, but again, he's not a portfolio manager. I mentioned that because we have whatever you view is our responsibility under Section 208. And the target of our portfolio managers are, and Mr. Chadwick can probably advise better, but I believe the target is for us to be at 20, 25, or possibly 30% of our portfolio in investments of this kind. And I want to be careful that people are deliberative in what they approve in that connection. Thank you, Mr. Chairman. I'm sorry about my long tirade here.
Be honest now. Are you really sorry?
No, not very.
Okay. Mr. Norton,
John,
I had you scheduled last week to speak next.
The only question I have, two funds for which are coming out.
I'm sorry, what?
The funds for which are coming out.
Okay, well, GAM has no investment in it. Oh, the funds of which we are exiting. To fund that? We do, because we sold one of them today, which was the Loomis Sales Bond Fund, which was, I believe, $20 million, something like that. And the other fund that we will be selling is the Loomis Sales Global Fund. It's around there.
I have the numbers in front of me.
I have them here, too.
The Loomis sale fixed income was $20,062,000 as of August 31st. The Global Bond Fund was $12,470,000 as of August 31st.
I don't know what you mean by that.
Oh, no, we don't have an update.
I don't have it updated from, well, it's going to be sold tomorrow, so I can't tell you what we got. But we voted to get rid of it. I have the value as of August 31st. It's been a very interesting market as when the Fed has Well, the yield curve is flattening in here, is what's taking place, and the long bond did not rally when the Fed said we were not going to cut interest rates this month. However, if it would make you happy, Mr. Raymer, I'll commit the board to saying this will never be part of the fixed income bucket. Would that solve your issues?
No, that wasn't particularly my issue.
I know you think of bonds as being ballast. Right now, I think of bonds being a dead weight. And I've come in here and talked about this before. Going forward with the bond market having a 30-year rally, chances of it ever returning anytime soon, the kinds of returns that we've had recently, are very close to zero. And how are we going to make 7% if we have only a small amount in non-bonds? And in addition, a great problem exists even in our bond portfolio of trying to find something where we can put money in that will give us a better yield than just governments or standard corporates. We're not alone in this. Everybody in the world is doing the same thing. And so we have been pushing the fund off into bank loans. We have, you approved a bank loan fund not very long ago. Today you approved another one, which was for loans to mid-sized companies. We have, I believe, 6 or 7 private investments all honed in on fixed income type securities.
Yeah, I guess I'd like to focus on a couple of things. One is risk. Only half of this fund is in North America, so you've got significant foreign exchange risk here. I just point out for everyone's amusement.
The total fund?
GAM unconstrained bond.
Oh, you're talking about GAM. I thought you meant the entire portfolio.
No, this fund.
Okay.
It has emerging markets are 11%. And I just point out for your interest that it's a small investment, but 0.2% is invested in bonds in the supernatural. It's actually in here under Eastern Europe, supernatural. I don't know if you get a prize if you point this out to the portfolio managers, or they did it as a joke or something. But in all seriousness, you've got below investment grade credit here, 11% in emerging markets. Convertible debentures are 12%. FX, so you have a significant foreign exchange risk. Emerging markets, we didn't do so well with the emerging markets debt that's in there. It's already 4.5% of the portfolio. And I think the Brits would call this a bit of a dog's breakfast. Does it make sense to have this in a fund that is in such high-risk investments in something?
I don't know why you're making the assumption that they're long emerging markets without some kind of hedge against it. This fund has been around since 2004. These are just not new kids on the block.
11% is in emerging markets.
They've lost money in 1 year, 2008, when they were down 1.8%. I don't want to go into what the other markets were down. So to pretend that they don't know what they're doing just because you're not comfortable with them, I think is a mistake.
Well, of course, past performance is no indication of future performance.
Of course not.
So let's keep that in mind. And
Jesus, we keep that in mind on everything.
I'm going to consider this item going nowhere, or we're going to move forward. We can ask questions, or you can...
thought that was what I was doing.
Could I...
Well, I was asking a serious question about the risk in this fund, and I guess I'm not going to get an answer on that.
What I'm suggesting to you is it wouldn't have an A rating if some of the things that you consider risky aren't offset by some that are not risky. It's the whole pile together. It's not one individual investment that they make.
NEPC, we pay to research these matters for us, and like Mr. Raymer said, they are the experts at this, in addition to the retirement board. They provided a report on the unconstrained sector, which would apply to both GAM and the Strategic Alpha. I didn't share the whole 5 pages with you, but anybody who would like it can have it. But let me summarize it by just reading 2 sentences from it. NEPC research finds unconstrained fixed income strategies to be a conservative fixed income approach with a flexible investment mandate of high conviction ideas managed within a target risk budget to mitigate global macro risks. What they're trying to say in that sentence is this, in your fixed income portfolio, this is a conservative part of it, not a risky part. And let's remember, it's fixed income. It's not equities. Another thing they write is NEPC research believes the primary purpose of an unconstrained fixed income strategy is to deliver a consistent real return with low correlations to interest rates and turbulent equity markets, while also providing a diversification benefit that mitigates an investor's overall portfolio volatility. So what they're saying is, if you're subject, as we are, to interest rate risks by having a big fixed income portfolio, and you know, as Mr. Chadwick has said, and everyone knows, it's coming, that interest rate increase that's going to punish your fixed income portfolio, then this vehicle, or this category, as they say, NEPC, a consistent real return with low correlations to interest rates and equity markets. That, in a nutshell, is, I think, valid analysis, and I think it supports the decisions made here. You want to reduce the volatility of this portfolio. That's why you chose this vehicle.
Okay. Approval of the GAM unconstrained fund for a maximum investment of $40 million. That item's been moved and seconded. Ms. Tarkington?
I'd like to ask two relatively quick questions, just of either Mr. Chadwick or Mr. Minarski. One of our requests by the Law Committee was that the Retirement Board approve in writing, so I assume that means in your minutes, the change from 10% to 40 million. Was that done at your meeting? Approved it to 40 rather than 10%?
That was approved today. The minutes aren't out yet.
Okay, well, but it was done, so it will be recorded. My other question through you, Mr. Chairman?
But let me say, Leslie, it was also sort of left open in case people really gulped and took 10% as an acceptable number.
What, I mean,
In other words, we came up, first of all, why don't we say we can put 10% of the portfolio into one of these investments? People weren't happy with that. I'm sure, from what I understand, you're one of them, and wanted it to have it $40 million.
Right, a finite number.
That's right. So, I mean, we came here ready to go either way.
So that piece of it you would do. And then through you, Mr. Chairman, I'd like to ask Mr. McLaughlin a question, please. Mr. McLaughlin, in the resolution that we discussed together and he then finally prepares for our Law Committee, did include there, which was part of our discussion, that this would be subject to any conditions or qualifications that may be contained in the opinion letter of the Law Department. And I don't believe we've received that updated opinion. Is that correct, Mr. McLaughlin? And where do you plan to head on that, and when do you plan to complete that project?
Thank you. When our outside counsel, Mr. Hammersmith, reviewed this, he found that the investment was in legal order and approved it as such. I reviewed and discussed with him, his opinion on that, his due diligence memo, his side letter to address a lot of the issues, and gave our approval of what he did. At the meeting of the Law Committee, it appeared that perhaps the thrust of what the investment was going to be was to fit this particular investment within the 25% of Section 208 of the 208A of the Charter. And so Mr. Hammersmith and I discussed that, whether it would be a fit or not. and felt that if it was going to be considered to be that part of the portfolio that fit within that 25%, that several things had to happen. One was we worked on revisions to the investment policy statement that would clarify that this was the intent of the retirement board to put it in there so that there would not be any inconsistency within the investment policy statement. And also get a clarification from NEPC that they were aware of that restriction in the charter and that their determination of this as being within, fixed income fit within what the charter language was, not as a legal opinion, but as a professional opinion on that. There really wasn't enough time to effectuate all these things because we were basically scrambling on that to have everyone vetted out, the retirement board on that, and get enough distribution for everyone to consider it. I met with the retirement board this morning, and they said, as Mr. Chadwick has said, that they are not trying to put this within the 25% of the restriction of the fixed income because they already have 25% of the fund, of which they consider to be not much of a question, but that is the fixed income cash type of investment. So at this point, since it is not considered to be a fit or trying to fit within the 25%, our original opinion and that of our outside counsel is that this is a fit for the investment, not necessarily a fit within the 25% at this point without more work on the investment policy statement and more work from NEPC.
Will you be putting that in writing to the members of the law committee and obviously,
If
copy
you
to the
want, I
board?
think that, that's a fair point. We'll clarify that that's our understanding, that it is not meant to be put within the 25% at this time, and therefore we have no further conditions to put on it.
Okay.
Okay.
I think that having something in writing to clarify this would be very constructive.
Mr. Blankley?
Just briefly, Mr. Chairman, Mr. Raymer spoke for me a little while ago. I'll speak for myself.
I apologize.
Well, that's no. In fact, you spoke correctly about me. But I just wanted to repeat it. I think the discussion in this board of the virtues or otherwise of any particular investment, risks and returns and so forth, is inappropriate. This is within the purview of the retirement board, so any discussion we have on such matters is OTOs.
Is there anybody who has not spoken? Ms. Weissler, followed by Mr. Raymer.
Just two quick comments. Mr. Drake talked about the NEPC report on unconstrained bond funds, and I did read through that report. I thought it was helpful in terms of an understanding. However, it did note in the report that these funds have only been around for a relatively short period of time, so they haven't yet had to adapt to a rising rate environment. I realize from what Mr. Chadwick said, this has been around for longer. And I guess the other comment that, given the low interest rates, the expectation of rising rates, the challenge of meeting our 7% target, I think we also have to take into account, do we want to take on more risks across the spectrum to get that 7% target, or is another alternative to look, do we bring that rate of return down? That's not for tonight, but I think that's worth taking into account.
Mr. Raymer, last speaker on the item.
I get to that last word.
But you did say before you promised you were done.
I was done at that moment, and since then, other clever thoughts have come forward.
Would you like me to ask the recording secretary if you did? Okay,
Let's just say this, the attorney, who you say has seen thousands of these, approved this deal. So he said it was okay.
As being in legal order, as did my law committee. And indeed, I voted in favor of it being in legal order. Mrs. Weissler has put it extremely well. We're spending in the current budget, I believe, roughly $22.5 million of funds that go into the retirement fund to keep the fund funding the ARC. If we make a decision to invest more conservatively, to take less risk. The probable result of that is we end up having to fund greater sums to fund the ARC. The judgment of when we take risk or when we condemn the taxpayers to pay higher taxes at an increased mill rate is uniquely ours. We turn around to NEPC and we ask them to make recommendations of investments to us that fill certain judgments that are being made by the retirement board. But at the end of the day, it seems to me the last word on making the decision between balancing risk against tax burden is ours. And that's the reason why I keep raising, meeting after meeting, my concerns about the level of risk, because my personal judgment as merely 1 out of 12 members on the board is I feel like we're taking more risk. I myself would have been willing to take less risk, even if necessary, at the cost of asking our taxpayers to make an additional contribution to fund the ARC. And that will be my last word on this, Mr. Chairman.
Before,
I'm sorry, can I make one comment? I have not spoken on this topic, Mr. Chairman. I ask that I make a short comment. Thank you. I would just remind all of us that when we talk about the actuarial ARC, that is a snapshot in time based on valuation as of July 1. The Retirement Board is working 12 months of the year to achieve that 7% return, and it's really hard for us to isolate 1 or 2 or 3 decisions that come before us in the same night and evaluate their performance and the risks they may or may not have taken on. So that sort of adds to Mr. Blankley's comment, but with a reminder of how the actuarial snapshot or the valuation works. It doesn't happen over the course of 12 months. It's at one time in July after they've done 12 months of work. Sorry, Mr. Chairman.
okay. Peter, if you would, just as a footnote for me, can you make a note that all future retirement board investments, we're going to have a little different procedure on how they get here? We need to create a little different form, because you can't get to the item on the table like this to have the opinions and these questions come out then. We have a committee structure. We need to do that. With that said, approval of the GAM Unconstrained Bond Fund. Item's been moved and second. All those in favor?
Aye.
Opposed?
Nay.
That item has, abstaining. That item has passed 10-0.
3.
930.
I'm sorry.
Three.
We're,
Goldrick, Weisler.
oh, I'm so sorry. 930. Okay. Our next item, and I think we've had the discussion on this. Okay, Mr. Drake, do you have anything on this one to add?
No, nothing to add. These are, well, I'll add this briefly, which I already said. The 2 Loomis sales investments are investments that are already approved and already held in the retirement board. And so what we're doing is raising the limit so that they have the tactical ability to react to markets and do their charter designated task of managing the funds as a trustee.
Okay, Mr. Raymer, is this the item that you wanted to make a comment about the law committee not reviewing?
Yes.
Okay, Mr. Raymer?
I'm actually a little surprised at how it was handled then. First, I need to mention, by way of history, that the Loomis Sales Senior Loan Fund was approved by the BET, the Law Committee also, back in January of 2014 at $13 million. The Loomis Sales Strategic Alpha Fund was approved by the Law Committee and the full BET a year later in January of 2015 at $10 million. The increases to $40 million are certainly a substantial increase. While Mr. Simon did attend our meeting and did indicate to us that he would be coming back to us for approvals, probably to $40 million, in each of these 2 funds, $40 million each. We did not review it, and I don't believe I don't know if the existing agreements require amendment. I think the existing agreements are specific at the $13 and $10 million figures that I spoke about. So I think an approval to $40 million would require an amendment to the agreement, which means that I think it would require the vote of the BET, and normally that would have come first of all, through the town attorney, and then secondly, through the law committee. The approval of the town attorney is required under our charter. I don't know if the town attorney is prepared to approve something which has never been submitted to it in writing. But in any event, the law committee has not reviewed this, was told that they'd be coming back to us, but they did not come back to us at this point.
So are you making a
I frankly
motion
think
to
this increase is premature.
Are you making a motion to refer this back to the law committee?
Yes, and I would.
I have a second on that motion.
Second.
And I would propose that this be moved to our agenda for next month to give us an opportunity to do just that.
Well, the motion to refer to committee is at your leisure.
Okay.
Okay, we have a motion to refer this item back to our law committee. It's been seconded by Ms. Tarkington. Discussion on the motion to refer. All those in favor?
Aye.
Opposed?
Opposed?
1, 2, 3, 4, 5. Okay. All those abstaining? So that's a 7-5-0. Am I correct? Okay, that item has been. That brings us to our next item. Mr. Drake, approval of resolution concerning cash management.
Sure. Again, you have materials in your package about this. The topic is the investment of the town's cash balances. In today's low interest rate environments, we earn, I think, 12 basis points on our excess cash, which is pretty pitiful. And we're trying to do better with the taxpayers' money. So the concept here is to undertake a managed program of investing in bank CDs that get the quality rating of the two highest categories from IDC, which rates these CDs and issuers, in amounts less than the $250,000 of FDIC guarantee per depositor. So, in my opinion, you're taking essentially no risk. You're taking the risk of the federal government. So the Investment Advisory Committee voted 3-1 in favor of this. The proposition is to invest $10 million of our cash balances of $90+ million in this as a way of putting our toe in the water. These are investments that are routinely done by other municipalities in the state of Connecticut, all our peer communities, many of them, and with the possibility of earning 70 basis points on the $10 million projected to be invested here. The earnings increase is $68,000. I think we owe it to the taxpayer to obtain that with the risks that are very low. So again, we voted 3-1 in favor of this.
Okay, so that item is before us on behalf of the Investment Advisory Committee.
Mr. Chairman?
Discussion. Let me just start here. Mr. Norton?
Yes. Yes, Mr. Chairman. I was the no vote in the Investment Advisory Committee, and actually what I'm going to do is propose a modification of this and referencing the third further resolved within the resolution, and my motion is to delete that resolution. And if I get a second, I'll give you the 3 reasons that I'm making this motion.
Okay, so we have a motion on the floor. So we're clear. We have a motion to delete the third further resolved, which that the treasurer may, with the approval of the controller, invest up to so on. Do we have a second on that motion?
Second.
Seconded by Mr. Goldrick. Discussion on the motion to amend. Mr. Norton?
Okay, my reasons for opposing this is that this further resolve totally compromises the substance and the intent of the immediate prior resolution, which in effect requires any bank with which we do business to have an investment-grade policy. Further, the explanation provided by the treasurer referenced justification by IDC Financial Publishing, a ranking and rating, we're using a ranking and rating methodology. Subsequent to the savings and loan crisis a number of years ago, the Fed mandated that banks report and publish multiple ratios about their performance. These reports have been used more extensively on Wall Street for years as part of bank analysis. However, publication became mandatory subsequent to the savings and loan crisis, and IDC subsequently adopted a formula to choose select ratios from the many, and there are more than 40 ratios that are used by most banking analysts to develop their rankings and ratings. IDC uses a subjective rating system in which they choose which they do want and do not choose to ignore. As I indicated, the analysis used by IDC is not recognized by the Wall Street analyst community when they do their analysis of banking companies. There are two principal ratios that are concerned in the investment community, which are the summation of most of the ratios that are included within the IDC. One is the cost of capital earned, and the second is the cost efficient ratio for each bank. The latter is very important to the earning of both capital as well as the return on equity that a bank makes. And the cash efficiency ratio is basically a summation of all the ratios that are used by the investment community. All company financial analysis has an element of subjectivity. However, quantitative analysis has defined metrics, and the IDC Campbell fails that test. I think this change of policy to earn a few additional basis points on the town of Greenwich cash balance is not in the best interest of taxpayers, even though the substance of it and the basis for it, which I believe the current policy is good public policy, is dependent upon a government insurance program provided by the FDIC. Furthermore, the CDs that are offered through the IDC plan are all brokered CDs. Brokered CDs have the highest cost, as well as they have a direct effect upon the bank cost of capital and the cash efficiency ratios that the banks need and required basically by the analysis. The standard of cash efficiency ratios is 60%. It's an inverse ratio. The higher the cash efficiency rate, the lower the performance of the bank, and the more difficult it is to generate earnings profit. Campbell does not measure various things such as delinquency rates, as well as charge-offs of the various bank proposals, and therefore, I do not believe that this is good policy. This is a good policy change by the banks. Also, I believe that the Treasurer would be able to get, by using CDs offered by the banks that are listed, and in this cash management proposal, higher rates of return if we use CDs similar to what the broker CDs offer.
Ms. Tarkington?
Yes, at an appropriate time, I would like to make a motion to refer this also to the Law Committee. I don't think we've seen any documentation for this. But I wanted, since our town treasurer is not with us this evening, I was wondering if we could ask the controller through you to make any comments on this, to give us an idea of who this firm, Alvarez and Marcel, is. They've only been in this business for the last year. And also, if he could tell us who, there's going to be a custodian to hold these securities, and if he could tell us who U.S. Bank for Institutional Trust and Custody is and what their credit rating is, and just a little more information. That would be helpful.
Okay, Peter, we are on a motion to delete an item that, to modify an item that's before us, but I think those questions are probably, they're going to happen whether we dispose of this motion or not. So I would ask those, if you want to opine on that.
I think there was three questions there, but let me back up and start at the beginning. This is an existing cash resolution. On the front page, for example, you can see where we have a list of banks. 4 of them are in your treasurer's report: Bank of America, JP Morgan Chase, TD Bank, Webster Bank. If a new bank came along and it wasn't on this list, the controller and the treasurer can't invest in that bank without the approval of that bank being put on this resolution. It's required on their end and our end. It also has to be a qualified public depository per state statutes. And then there's the investment requirements that are governed by the state statutes in the 7-400 series. To answer the question, the legal question, step one, the plan was to get A&M to get the program accepted, the resolution passed for everything else that's on here, and then Kathleen was going to work on the contract through the law department. So that had been planned all along. We weren't this, and it's mentioned in here, we need contract approvals on almost everything that's in here. So what we had planned was step one is to get the approval to go to A&M and then go to the law department for contract approval. So that, we wouldn't have started that process without the law department and the BET Law Committee. A&M has only been in this particular business for 1 year. I had the opportunity to meet with the marketing manager, and let me see if I got it. They have not been around for a long while, but they were founded in 1983. Alvarez & Marshall is a global restructuring professional services firm with 2,500 employees. A&M led the global wind down of Lehman Brothers, during which their financial team was responsible for the investment of the liquid assets. They developed their platform to manage and invest brokered FDIC-insured CDs. And last year, they launched this particular program where they went to the individual towns. They're a private equity group. They have an office in Greenwich. And also, we had the potential to use other brokers. Kathleen went around, and there's dozens of towns that use the out-of-state CD program. She actually went to a series of towns for reference checks, not only for A&M, and I'll get back to why we selected A&M. Fairfield, Shelton, Norwalk, Westport, Newtown, Westport, Waterbury, Glastonbury, we all got references. There was nothing negative from any one of them. And we couldn't determine the last amount, but there's dozens and dozens of towns that already use this program to get yield. As far as the risk involved, there's a comment in here that I can't remember when the FDIC was, no depositor has ever lost a penny of insured deposits since the FDIC was created in 1933. None. The plan was, and I mean, it's still going to get back to A&M, is to take $10 million, split them up into a series of $240,000 each, and give them to A&M, and they would spread them around. The problem with using other brokers is we would lose control, and potentially if we used, and they're listed in there as far as the other potential brokers the other towns use, we wouldn't have the control that if we got, say, 3 investments in one bank where we had $750,000, then they would be at risk, because we'd be over the 250. The reason we picked 240 is because there's interest that accrues to it. The third question had to do with the custodian. The custodian was U.S. Bank, and I don't know how they're rated. I can get back to you on that. They charge, they're investment grade?
No, investment grade.
Okay, there's the answer. And they charge 2 basis points, so they would cost $2,000 on a $10 million investment. Going back to A&M, on page 3, you could see the section that in red where Northern Capital, Janney, Montgomery, Scott, et cetera. We had the opportunity to use a number of them. And because of the reasons I explained with A&M, we would lose control over them, the potential to have 2 or 3 of these brokers put the money into the same bank, and therefore the risk. Is there any other questions as far as? But to go back to the resolution in its entirety, this was last passed October 13th, 2010. And I need, in the case, if there's anything that's not controversial, to be voted on, so that we can keep abreast of putting money into banks, if we want to change the people that are listed on the treasurer's report. Okay. So what you're actually doing is, I know you're amending the resolution, but you're voting on the resolution. You have to come to a vote on. Well, you don't have to come to a vote. You're just not going to update this resolution. But if you're going to amend the third further resolve, and I'll defer to Art on this, I think you have to also go into the third page, because it ties into the fifth or sixth further resolve, if that's what your intent was. If you're, in other words, if you're rejecting the third further resolve, we're not going to use A&M for anything.
Okay.
Leslie, did I get everything?
Yeah, you did. Thank you very much, Pete.
Okay. So back to the motion to amend. I have Mr. Goldrick next.
Yes, Peter, if you would, please. I think Mr. Norton's concerns are in terms of credit risk, counterparty risk, and being over the limit for FDIC insurance. Am I basically, is it the credit risk that we're looking at here for the firms that we would be dealing through? Have I got that right?
That's correct, but that's the only one that you mentioned that concerns me.
And we do have the counterparty risk with Alvarez and so on, because if there is some sort of malfeasance for that institution, they haven't been making the investments properly or something, that is a potential risk, is it not?
I'm sorry, I didn't follow you.
The counterparty risk for Alvarez or another of these brokers that we're using, assuming that they do something that our investments don't get made or for some reason they go bust, that is an additional counterparty risk, correct?
The investment is in the bank, and the money's held by a custodian. They have a program where they place the investments throughout the 48 states. I don't know if they go into the Hawaii and Alaska. So I don't see any risk with A&M.
Your feet.
Kathleen did the grunt of the work here, but I could follow up on the risk with A&M as far as loss of principal as far as the CD.
Okay, Ms. Kiernan?
Mr. Minarski, just a quick question, and first a thank you for all of the work that's gone into this recommendation. I know this has been going on for months. But in the, I think it's the Investment Advisory Committee report, there's mention that the 10 million is, it's 10 of the current 97 million cash balances. I just want to understand, are you saying that 97 is sort of the low point in our cash balances during the course of the year? I want to understand where that 97 sits on the sort of double dip we take through the year with our cash.
I believe the low point is about 20 million lower in the 70s.
Okay. Okay. Thanks, Pete.
And it's just general fund we're investing here.
Correct.
And I will follow up, Sean, is with the A&M as far as to your question. And these are also, again, 2 points. Number one, they're allowed by state statute, and this program is commonly practiced throughout the state of Connecticut by a number of towns, of which I named about 8 of them.
Okay. Mr. Blankley?
Just briefly, Mr. Chairman, I'd like to reiterate the thanks expressed by Mary Lee just now for the work done by Treasury. In my commercial and business experience, the work that's gone into this from a Treasury perspective is exemplary. Could I, through you, Mr. Chairman, ask our controller, all these amounts that we are talking about are FDIC covered, is that correct?
To 250. Are they all FDIC covered up to 250? All
The banks we're going to invest in?
Yes.
Yes. And they also, going back to that rating, they have to have that 165 or above. There's 6 groupings there by that bank rating agency, and then of the 6, it's one is superior and one is excellent. So they're top banks in the country.
And one other small comment, Alvarez and Marsal, I happen to know, and they are a first-class firm in all they do.
Okay. All right. On Mr. Norton's motion to amend, what that would do is that would take the third further resolved and remove it. Okay? All those in favor of the motion to amend, of Mr. Norton's motion to amend, signify by saying aye. Mr. Norton? All those opposed? Abstaining? That motion has failed. That brings us back to the original motion from the Control and Investment Advisory Committee. Discussion on the original motion. Do we have any further?
Mr. Chairman, I had thought I would refer this to the Law Committee, but Peter Minarski explained his intended process.
It's going
and
there
I think that protects us, so I don't need to do anything further.
Okay. Further discussion. All those in favor?
Aye.
Opposed? Abstaining? That vote is 11-0-1. Okay, continuing on.
Pete, I had a question. I don't understand.
You have a question for, did you have a question?
just vote to refer this to the law
No.
No. Sorry, I
We voted.
misunderstood.
It's approved 11-0-1. That brings us to our next item, which, if I may, the BET has to, next month, approve a calendar, or at least a framed-out calendar for next year. Obviously, this is about getting meeting rooms and times and setting up the budget process. So in working this up, Elaine, and I've had some help from some of the members here, you'll see it's all highlighted by color. Obviously, some of this changes. There's a few work sessions that we have done typically that are not on here, but we typically schedule those on a need basis. We've had special meetings. They're not on here. Obviously, I think the Budget Committee is planning a special meeting October 5th. That would be added to the calendar. But this is our basic calendar. It represents the department hearings. A few changes on here. You'll see some weird times. June, as an example, I'm moving I think it's the BET meeting, I'm moving up earlier, I think it's June, in order for the RTM, because we've typically been meeting after the RTM, and that's year closeout, so if there's an interim or anything that they need that the RTM would have to approve, I want to be able to, for us to address that and then make a phone call over to the RTM, and so they know that we've acted on it. So this is for review. Please send me comments, questions. Committees, obviously, you know your normal routine. This deviates a little bit. We've changed some times, but we will approve this next month. It will be on our agenda. Brings us to 10, old business, debt policy biennial review. The debt policy review began, I think it was May. We had a working group formed, and that working group was Ms. Kiernan, Mr. Finger, Ms. Weisler, Mr. Drake. That group has brought us 2 resolutions, but I'm going to actually call for the working group if they had a committee report, and then I'll entertain the resolutions that are included in your package and any modifications, motions, or anything like that. So with that, Mr. Drake, I think I'm going to call on you first.
Sure. Thank you, Mr. Chairman. In your package, you have a very brief half-page report from the working group, which in essence said that 2 versions were reviewed, 2 versions of debt policy were reviewed, each achieved a 2-2 vote, and both are before you tonight.
So at this time, I'll call on Ms. Kiernan. Would you like to move one of the resolutions, Mr.?
I would defer to the co-chair of the committee, which is Mr. Finger, our caucus leader.
Oh, I'm sorry. I got confused. Mr. Finger, I'm sorry.
Mr. Chairman, I make a motion to approve the debt policy draft, that it's the first one in the packet that's indicated on the top. It reads, first read, proposal of Democratic members of the debt and fund balance policy working group.
Item has been moved, seconded by Ms. Kiernan. Mr. Finger?
Yes, thank you, Mr. Chairman. We had a fairly lengthy BET discussion on this draft, both drafts actually, in July. So I'm going to try not to be overly repetitious. But what the attempt that was being made in this draft was to provide the BET with flexibility in determining maturities and allowing the BET to do what the BET is charged to do under the charter, which is to make decisions on the financial affairs of the town. There are a number of changes in here that are proposed that are consistent with the basic framework of debt policies that exist in communities throughout Connecticut. I'd like to just point point you to a few of the sections here. One is on page 2 of 4, and it's the last paragraph on that, the second paragraph under that section, and the language that we propose to change. It's found in the second sentence, so that it would read, "For the general fund, the town may thereafter finance capital projects through the use of general obligation bonds with maturities not greater than 20 years or the average useful life of the asset, whichever is less. After consultation with the town's financial advisor, the controller and the BET shall, after consultation with the town's financial advisor, the controller, and the BET shall determine the maturity of each such bond." Again, Mr. Chairman, we've had this discussion frequently in this board over the last couple of years. This is probably the most, in my opinion, most critical section of what we're proposing. It is to provide flexibility for this board to determine the maturity of bonds. And it doesn't say that we're going to be doing them for 5 years, 10 years, 15 years, 20 years. It just gives this board the opportunity at the appropriate time to make the decisions as to the best way to finance capital projects.
Thank you. This item's being, so you're making a motion at this, and we have a second by Ms. Kiernan. No committee report. Discussion. Ms. Kiernan?
So I want to also thank Peter Minarski and Roland, Nancy, Bill Drake, and Bill Finger. We did meet half a dozen times on this topic, which is, as Bill said, vitally important in our role as financial stewards of the town. Because we really have, the question before us is an alternative, one or the other. I do have comments on both proposals that I'd like to share with you. And with absolute respect for all the colleagues that worked hard on this, I do have some concerns about the Republican proposal that I need to run through. A debt policy should communicate really broad strategic goals with respect to issuance and management of debt to a community, typically using ratios or percentages that help manage and guide a debt portfolio, so that the debt service doesn't overwhelm a municipal budget or outpace growth in your tax base. However, the policy offered by our colleagues contains a hard cap debt ceiling of $280 million, which is an increase of $70 million over the cap passed by our colleagues 2 years ago. And I think we've all acknowledged during our working group sessions that we have gone over that debt ceiling. The number that we had heard was $213 million, which is over the current $210 million limit. And in the financial model that accompanies our colleagues' proposal, it is projected that we will exceed the new proposed limit of $280 million in 3 years. So I'm respectfully finding it difficult to vote for the alternative proposal when we are projected to exceed it in the very near future. We need a policy that will make sense over time. Secondly, there is no guideline or directive in the Republican debt policy that connects debt to changes in our tax base. The alternative proposal only provides an observation about what the $280 million debt ceiling represents today as a percentage of our equalized net grand list. And of course, that snapshot in time will soon be incorrect. And as we saw in the many comparable debt policies we reviewed from other communities that are also AAA, there's usually a ratio of debt to equalized net grand list, creating that vital connection between our level of debt outstanding and a community's tax base. And our colleagues do offer another requirement in their debt policy in the form of a ratio of debt service to the capital tax levy. And that capital tax levy, for the benefit of the public, is that amount we tax every year for capital purposes. This ratio simply does not exist in best practice publications, in rating agency publications, or in the debt policies of comparable communities. And our controller has said 2 years ago and again during our working group sessions that this ratio should be taken out of our debt policy. In addition, according to our colleagues' model, we will violate this ratio in 3 years. So respectfully, again, I have concerns about that approach. You know, in the many materials that we diligently reviewed during our meetings and in between our meetings, we looked at the GFOA guidelines, which is the Government Finance Officers Association guidelines on drafting debt policies, which our controller gave us. And it says, quote, financial limits are often expressed as ratios customarily used by credit analysts, end quote, and yet the controlling limiter offered by our colleagues is a hard cap, not a ratio. And the GFOA also suggests, quote, appropriate debt limits can have a positive impact on bond ratings, particularly if the government demonstrates adherence to such policies over time. Yet again, the policy suggested respectfully by our colleagues is one that we have not adhered to in the past and we are projected to be out of compliance with in the near future. But let me just touch on Bill Finger's important point, which is the debt policy suggested by our colleagues is inflexible with respect to the maturity of the debt that the town can offer. We can go to the markets and sell 5-year general fund debt, but cannot bond at maturities greater than that. 5-year general fund bonds are acceptable, 6-year general fund bonds are not, with no analysis to support this distinction. Similarly, 20-year Nathaniel Witherell debt is acceptable in our colleagues' debt policy because it has a revenue source associated with it, but 20-year general fund debt is bad, even though general fund debt has property tax revenue associated with it, and indeed, that is how these bonds get their AAA rating. It's our property tax revenue. Again, a distinction without a difference that I am having trouble being in favor of. And finally, the roughly $200 million of unfunded actuarial liabilities we have in our retirement system and our OPEB system are amortized over 15 or 20 years, but we cannot amortize our debt from the general fund over that same time period. So these are distinctions without a difference, and I have trouble supporting a policy that contains these. I also have to mention something we discussed at length, which is the trajectory of the capital tax levy in the model offered by our colleagues. And central to that model is the notion that taxes must go up every single year by $3 million for capital purposes, whether or not there are more capital projects in a year or less, or the same as the prior year. And we discussed this at length, of course, during the budget season as well. That change is a little under a 1% rise in the mill rate, no matter what. Previously, that model stopped increasing at $50 million. Now the model says that the capital tax levy will go up $3 million every year for 5 years, dip in year 6 slightly, and then increase by $2 million a year thereafter, again, without enough explanation to give me comfort about this policy. We did try to discuss some common ground, including flexible term bonding for offerings above a certain dollar amount and for certain capital assets like a central fire station that will be around for generations to come, but we did not make progress on that, what I think is common ground. But I do still hope we can continue to think about this and look at this option. So our colleagues' proposal reflects a rigidity and a lack of flexibility. And it should be noted that rating agency publications and methodologies do not recommend that rigidity. And in fact, Moody's methodology that we looked at states financial flexibility is a key area of analysis for Moody's, as it provides insight into a local government's ability to maintain or augment its financial position going forward, ensuring a sufficient buffer to address any unexpected contingencies. So in short, flexibility serves our community better. Let me just offer a few short observations on the proposal that Mr. Finger and I put forth. The Democratic proposal reflects a philosophy of modest debt levels in relation to our budget and our tax base, and flexibility around the issuance of debt. First, we constrain debt with a ratio of debt service to general fund expenditures of 10% and a ratio of debt to equalized net grand list of 1%. But let's be really clear here. The limiter is the debt service coverage ratio, as it is in many of our comparable communities, and that is modest relative to our general fund budget. We also offer flexibility in the maturity of general fund bonds. We don't require, as Bill said, any particular maturity as long as it is no greater than 20 years or the asset's useful life. Rather, the BET and the controller determine the maturity of each bond. And it's certainly a best practice in the private sector and among comparable communities we looked at. And this is an area where our own controller has experience. So our debt policy also offers the same flexibility in maturities for non-general fund debt, such as sewer improvement and Nathaniel Witherell. So what are the benefits of this proposal? In short, first and foremost, there is a potential for lower taxes in terms of potential savings to our taxpayers right off the bat for fiscal 17. Our controller estimates the 20-year bonding of items that he would choose to bond at 20 years this coming January, which is not the full $50 million we were looking at, but it's really about $30 million of that $50 million. He anticipates we could save between $3 or $4 million in fiscal 17, which is roughly about 1% of our mill rate increase. And secondly, we've talked about this many, many times before, we don't saddle our current taxpayers with paying back the principal on our debt in 5 years. We spread that tax burden across other taxpayers who will use buildings like the Central Fire Station for a generation to come. I think about senior citizens. Why should they pay off the principal on a building like the Central Fire Station in just 5 years when new taxpayers will come into town in year 6 and benefit from this facility? Third, our proposal provides the flexibility to respond to what is going on in the capital markets. Under our policy, we would have been able to lock in for the long haul the historically low interest rates that have been available since 2008. And let's be clear, we're not increasing the amount of debt outstanding in our proposal. We are merely providing flexibility in maturities. Our debt policy also puts the BET, the controller, and our financial advisor back in the game by enabling them to decide debt levels and maturities, which provides further financial discipline. That is our job, to provide that financial discipline and appropriate management of our debt portfolio. And of course, the most basic benefit is we're matching the useful lives of our town assets with the debt raised to finance these assets, a best practice everywhere for financing capital assets, whether you're in the private sector or on a town finance board. Let me close by offering what I hope is a very respectful and constructive suggestion about the financial modeling that all of us have worked hard on, and I certainly respect all the work that has been done by our colleagues in the last 6 months on this topic. I would suggest that our capital model have not one dimension or page in an Excel workbook, but rather 4 pages or 4 dimensions, which is far more complex. And that second dimension or page in the model should be a projection of the general fund budget over time, including fixed charges such as debt service. And the controller certainly does this already, but it's not directly connected into this analytic tool, this capital model that we've been looking at. The third dimension or page of this Excel workbook is a projection of fund balance over time, which makes a reasonable attempt to capture some of the school reimbursements and other insurance recoveries that are due to the town. And we acknowledge during our sessions how hard it is to gauge when they will come back to us. The fourth page of this model should be the mill rate calculation, and we need to project that out over time. And this is the sheet that typically accompanies the budget guidelines. This should contain, as it always does, assumptions about where the grand list is going. Very important for our thinking about capital asset financing. And back to the front page, let's place projects and years in a more objective manner, which accounts for the end of the useful life of any capital asset. All these dimensions, all these pages connect to the capital financing model, and they connect to each other. This is a multivariable equation that we're all struggling with, and I think we need to acknowledge that complexity and develop an analytic tool that'll help us change assumptions and see how this ripples through all the pages and all the dimensions of this model and help us make better decisions. So, Mr. Chairman, thank you for the time, and I would urge my colleagues to vote in favor of the Democratic debt policy proposal.
Thank you. Continuing on. Oh, I'm sorry, Ms. Weisler.
I just have a few comments. I would oppose the Democrats' draft policy for several key reasons. First, financing with longer-term debt will make the all-in cost of the project more expensive. It's obviously because interest rates for longer-term debt are higher than for short-term debt, and because interest costs would be incurred over an additional 15 years. If we look at interest rates at which Greenwich has borrowed since 2010, the interest rate for 20-year debt has been about 2% higher on average than for 5-year debt. And if you think of it on a personal level, and we know many residents here will choose a 10 or 15-year mortgage rather than a 30-year mortgage for some of the same reason. They want to save on total interest expense. Second, our debt policy, and I would say a debt limit, provide a very necessary fiscal discipline. Under the current policy, I'd say we've been able to maintain our infrastructure while funding important upgrades such as Central Fire, Nathaniel Witherell, MESA, 2 new elementary schools, and soon a third. In fact, the town has spent $600 million of capital over the past 10 years. If you look at the draft debt policy in front of us, debt could more than double to over $400 million. With a more liberal debt policy being proposed, I think the temptation would be to fund, quote, the nice to have in addition to the need to have. And as we think about how much debt is prudent for the town, we need to keep in mind that we already have $200 million of unfunded pension OPEB liabilities, which compares to the $200 million of debt we have on the books. I know there's been an argument that if we move to 20-year debt, this will lower taxes. However, I would argue that's a short-term, quote, tax holiday. If we were to look out over the next 5 to 10 years, you would then begin to be incurring debt for new projects while still having to pay off the stream of that 20-year debt. Finally, as to the argument that we need a mix of debt maturities, we already have that on our books. We have sewer improvement debt and Nathaniel Witherell debt financed over 20 years. As a result, about a quarter of our debt now has been issued over 20 years. And as to the issue with the capital tax levy, which is, you will see in our draft proposal, is to fund both debt service and a portion of capital projects, I would argue that this approach is consistent with the approach taken by corporations which fund projects in a combination of debt and equity. Thank you.
Mr. Finger?
With all due respect, Nancy, all the things that you mentioned that would occur from your, I think, your words with the policy that Mary Lee Cairn and I are proposing is not correct. It gives flexibility. They don't necessarily have to occur because ultimately the BET makes a decision as to maturity, as to the amount of debt we're going to incur. And one of the things that I think is I'm going to try to say this nicely, but it's probably not going to come out nicely, a little disingenuous, is when I continually hear that the Democrats want to increase debt. This doesn't increase the debt. This provides flexibility. The BET is a body that will make the decision, whether it's next year, the year after, whenever it is, as to what projects they're going to approve and what projects they're going to bond. So the mere fact that there's a higher ceiling because we're pegging it as a percentage of the equalized grand list doesn't mean that we're proposing necessarily proposing an increase in the debt levels of this town. And to say that there will be if you have that higher ability, that the the desire or the potential to reach that number, I think is doing a disservice to the BET, because again, it's the BET who ultimately will make the decision as to where they want their debt to be and how much that debt should be. So, again, our proposal, I believe, provides a lot of flexibility, and as opposed to the one that will be proposed, what I'll call the Republican proposal, which provides zero flexibility.
Mr. Johnson?
I'd like to start off with a question, either for Bill or Mary Lee. In your proposal, you talk about short and long-term debt of no more than 1% of the current equalized net grand list. In today's dollars, what would that amount be?
I think Nancy told you that.
Oh, I'm sorry, maybe I didn't catch it, that it was 490 million?
490 million.
Okay.
And as Bill said, that's not the intention of the policy.
Okay, so, but to maybe address, I mean, I understand, I respect what you and Bill are saying on that. It's not the intention of it, but again, you're talking about taking debt out 20 years on many projects. You're talking about a debt ceiling going from 210 million to 490 million. What I'm trying to get at is the temptation of doing a lot more projects in town. Oh, there's easy money out there. Why don't we go spend for this and that and a lot of other things, when we fully know that right now, I mean, some of the things we've talked about and we will talk about in the budget guidelines is $135 million of pipeline, in the pipeline for capital projects stretching back 5 years. That's either encumbered, appropriated, not spent, or under the current fiscal year. So what I worry about is the temptation of future BETs saying, gosh, we've got all this money, why don't we go ahead and borrow long-term, put the payment of that on the shoulders of the next generation, who will be having their own issues about different buildings, maybe even repairing some of the buildings that have been built in the last 5 or 10 years. I just worry that you talk about the flexibility. I think the Republican version is probably pretty smart to have some inflexibility to put a cap on what could potentially be spent and the type of financing. So we're saying two different things. We're going to have different agreements or disagreements on these different items, but I worry about a debt ceiling that's being proposed of up to $490 million, more than twice of what we got now. Yes, the current debt of $210 million should go up a little bit, and we'll talk about our proposal in a few minutes. But I think it's just not good financial sense to more than double our debt ceiling in one stroke and take out things 20 years.
If I may respond?
Mr. Finger?
I give the BET more credit than maybe you're willing to give. I don't think that the BET has in the past or will in the future be prone to temptation in order to raise the amount of debt that this town incurs. I will point out that when when the town first instituted a debt policy, whether it was 4 or 6 years ago, the debt ceiling was a hard and fast number. Whether we agree with it or not, it was $210 million. There was no temptation at that point to borrow $210 million. I mean, we're just hitting that $210 million number now or next year. So the mere fact that there's a number out there doesn't suggest, history doesn't suggest that the BET is tempted to then go right ahead and hit that number. So I think there is flexibility in what we have, and I have maybe a lot more faith in the wisdom of the 12 people that currently and in the future will serve on the BET.
Mr. Goldrick?
Yeah, I'd like to speak in favor of this motion. You know, New Canaan, which is a very Republican community, has a debt policy.
How do you know that?
Sorry?
How do you know that?
I've seen the vote returns.
All right, just checking.
Has a debt policy which states that long-term debt is an important tool in the management of intergenerational assets. And that's the way we should look at this, because MISA is going to be used by our kids, children, and so on. Same with a central fire station, a police headquarters, an ice rink, and all the rest of this. This is intergenerational assets. And simple fact is, simple finance, you match maturities. I would also point out that Ms. Weisler said, well, the cost is going to be higher. But finance takes into account real interest rates. And real interest rates right now and for the last couple of years have been virtually zero. So the notion that whatever it was 7 years ago, we would have had to pay that, I think Mr. Lash mentioned that at one point in a League of Women Voters forum. Well, there's something called a call option. So you can refinance these things at lower rates. And I would also point out, going back more than 6 months, we did this exercise, Mr. Huffman and I, applying these flexible rates to our investments, and found out that our capital tax levy would be about $34 million lower over 4 years than according to it would be under the current plan. So the other problem here, when you keep it short term, is that you make people vulnerable to rising interest rates. We are totally exposed to the short end of the rate curve. And if we get a raging improvement in the economy, and all of a sudden these go up 300, 400 basis points, we are exposed. We have not locked in those lower rates. So whatever you think that the cost would be, what we're recommending, it's going to be far higher to taxpayers over the next few years when rates go up. So this is just common sense. And I would just point out that no community in our region uses this short-termism.
Thank you. If I may, obviously, the motion before us is I'll call it the Democratic caucus, and obviously you have the Republican caucus, and there's probably going to be a small amendment made to that. I hear the conversation, but in watching this brew for 6 months, I think we need to try to look at it a little different. In your budget book in 2012, the 2012 to 2025 financial outlook here in the capital financing in thousands, for some reason, we're not at $265 million of debt like we projected back then. For some reason, we're not there. And here's the detail to it. I've heard comments about everything from cash flow to borrowing. So it was last week, obviously feeling the angst, and although everybody seems to be a lot more civil in this conversation, I called up Peter Bernarski and asked him, what's our outstanding debt? And I'm going to tease Peter a little bit. I got this long thing that he wrote for the working group. I said, Peter, give me the numbers of our outstanding debt today. He goes, well, we're at 198 plus 12 for North Main Sewer, so we're right at about 210. Good. The next question, you can speak up if I'm misstating it. What are you going to borrow in January? He goes 30.7. So I said, we're going to go from 210 to 240. I go, what do you make it for payments in this current fiscal year? He goes 26 million something or other. So I take the 26 away from the 30, and I said, well, we're going to hit 214. And as Ms. Kiernan says, in January, we're going to blow through our debt policy. Well, that's still only a couple percent. So I'm going to live with that little rounding error for the purpose of this conversation. So then I said to Peter, when's your next borrowing? He goes, January of 2017. I said, how much are you going to borrow then? So he says, I don't know. So I said, let's pick a number, because everything after this January is an assumption. The way to limit your debt is to say yes or no to projects at different times. That's the way you limit your debt, not by a policy. You say no, and on a unified, let's talk about where the BET is unified. And I'm looking at Peter Tessie in the back, and he's on board with us because he let Bill Finger and I come speak to the department heads and say, hey, look, we got a lot of capital that we've committed to, and it seems to be lagging, and there was stories about regulatory issues and all that, and he's pushing away on that, and fantastic. But what we all agree on right now is that we've approved a lot of projects. They're lagging behind. So what is our debt policy? Is our debt policy to put a limit on what we've said yes or no to? Because what's Peter Minarski's favorite saying? We use borrowings to meet cash flow needs. We don't borrow to all of our commitments. Let's take the next school project. What is it, New Lab? It's September 15. They have at least a year of A&E work, at least, getting through all the regulatory. Then they have to decide when they want to start the project as far as children. They're not going to probably start it at the beginning of a school year. They're probably going to start it towards the end of a school year like they did Glenville. It's reasonable. So that's another year. And then if we do a band, it'll be 5 years before we get the first 1/5 payment on New Lab. In 5 years from now, we will have paid back, under the current scenario, almost $150 million in debt in our current policy. So our current policy, let's go back to what we know. Well, I'm using $30 million a year, and if I go back to our current policy, the 210 is good today. It's really good in January if Ms. Kieran lets me slide on a little bit. And it's really good till January of 17. The current policy we have, because we don't do midterm borrowings. So with that, I say to myself, well, we were thinking pretty sharp when we did the original policy. We talk about borrowing long-term. The difference in borrowing long-term, and you saw it because Peter sent this all to us. If you take a $50 million borrowing at today's September 24th, 2015, quoted interest rates, it's $13 million more debt to pay back $50 million. And we can argue that because we could take the cash value and we can do all those analyses until we're blue in the face. But at the end of the day, had we done that for the last 10 years on capital projects over $10 million, and you take $250 million, because that's how much we spent or committed on these big projects, the town would have an extra $64 million in debt on the book today. And this is what we've done. This is not forecasting the future. This is live. This is real numbers. I would say we cannot make an assumption that 12 of us can agree on. It's just not going to happen. What we can do is only work off of what we know. Make sure that we let the taxpayers, because what is the debt policy for? We need to know, we need to have a model of what we anticipate on capital tax levy, what we anticipate cash projects, what we anticipate going to market for. That's what we need to know, because that's the purpose of the debt policy. That helps us work in all of the other, and then it helps us make decisions, not on capacity of doing, but then it helps us make decisions on projects, yes or no, to postpone them, to defer them, to relook. It's amazing when you save the paper from the old days. Who would have thought that we thought back then that we were going to be at $265,564,000 in outstanding debt, and here we are today at 210. And I remember the last 10 million of the 210 was a stretch. We put that in there for a slight, just in case. And we do have unknowns. We have unknowns. But going forward, I heard the capital tax levy mentioned. Well, that was a plan. Some say that plan doesn't work anymore, and some say the people who invented that plan got old on us. I don't say that. I say that plan works. And the proof is, had we not taken a couple holidays on that capital tax levy increase, our debt would be lower today. We chose that, and we shouldn't have made those choices, but we're dealing with the economic meltdown. So my feeling is, I appreciate all Peter's hard work. The committee you did, I attended only a few of the meetings. I know the hard work that went into this. I know this is a real philosophical. But I look at what we agree on. We agree that we want to get the capital projects that we've already voted on, the RTM's voted on, the user groups are behind. We want to get those going. Obviously, hopefully after this meeting, guidelines will be the next month's conversation. But I will tell you the Republican draft, there'll be a modification. There'll be a motion to amend a couple numbers. But with that said, that's all we can do. We can take the known and we can make assumption after that for how long. As far as the flexible, I hear about flexible financing. I honestly, whether we could appropriate 400 million in capital or another 90, I'm not sure you can tell me the actual timeline for it to get done. And if you can't give me a reasonable timeline, then what's the sense of telling the public that we're going to raise our debt limit to X and finance flexibly? This is a longstanding, I was going to say, I thought about this, I said, this is sort of like watching the same movie over again. It's not. We are actually evolving. We are now focusing on different things. But the point is, I look at it, and I could tell you, if you ask me what the debt policy is, I'm going to tell you what my question is. Peter, what's your anticipated borrowings in January of 17? And then the next question is going to be, Peter, what's the debt service scheduled for that year? And that's what I would add to the 210 for the second year of this. We have options. We could do a one-year extension. I don't think that does anything. I think we need to really plan. We have some big projects, that are in the hopper. So I hate to stop the meeting. I wanted to say thank you to everybody, but I think just as and I don't expect that 12 people are going to agree with what I'm going to say, except that where we are today. That's non.
Mr. Chairman?
Thank you very much, everybody.
Can I just react to that, Mr. Chairman, on behalf of the Democratic policy proposal? With respect to your comment on discipline, and it's really up to the BET to decide how many capital projects we do, and that is the limiter. That is implicit in our proposal, that the BET get in the game here and exercise the discipline that is needed to run our town's finances. Totally agree with you on that point. In terms of capacity, you spent a lot of time talking about that, and it sounds like you're implying that our capacity to get projects done on time is maybe somehow a driver of how this debt policy should work, and therefore how we bond. I think that's backwards. If we have a capacity problem, we need to deal with that, okay? I don't think we fashion a debt policy around the capacity of DPW or anybody else to get a project done. And third, respectfully, there's a lot of discussion and spreadsheets going back and forth trying to compare the cost of one form of financing or another. And we all have to remember that a present value analysis has to be done in a situation like this. And we can have all sorts of debates about the discount rate and the interest rates that we're using that can, move those numbers in either direction and support or not support your argument. But I would just point out that in paragraph I that exists in the current debt policy and also the Republican proposal, the use of present value to figure out whether we should refinance a particular offering is required. So I do not understand respectfully why it is not required when we initiate an offering.
When you talk capacity, I think my example of, not to have a debate, but I think my example of New Leb School, we all voted for it. We're all ready to go. It's going to be a $30-something million project. We're not on the hook for the whole with the reimbursement. But if we're not going to even have a principal payment for a 20-year note or a 5-year note for 4 or 5 years, to bring that number back in to the debt policy of today, it's a commitment of the town. But to bring that back in to our, and I forgot to say one thing, to our policy, okay, it's just, I just don't think that's wise. If we're at 210 now, and let's say New Leb was the only project out there 4 years from now, we can't borrow the $30 million for the school, or the 10 because of the reimbursement. We can't borrow that money today. We can't borrow the money and sit on it. We borrow to meet cash flow. So even when the $30 million project comes in for the Leb School, what do we anticipate the first contractual obligation is in the building contract? Is it a third? That's my point. We can't go borrow money unless we can commit it. We're not permitted to do that. So I think that's sort of the consideration. And I look at the debt policy as the tool that we use to throttle the town. And as far as long-term debt, I've said it before, the town could make a change and change it all borrowing to 20 years. It's not going to likely happen right now, but it could. But why would I want the next generation to have to pay for the vision of what we want? The most important thing about the town of Greenwich history, whatever the history books will say, the people in the town of Greenwich, whatever they got, they wanted it and they were willing to pay for it then. So everything that we use today, somebody else paid for. In theory, I'm exaggerating a bit, but so the town of Greenwich has historically been in a position where whatever the residents in the town wanted at any given time, whether it was buying Todd's Point or whatever it was, they decided they wanted it, they decided they were willing to finance it, and prior to the modification, what we call modified pay-as-you-go, they actually did the tax levy over 5 cycles to pay for those projects. So the diversion from that could happen. Going back from that to what we have now, not likely. Well, it's a luxury. It's a pure luxury the town of Greenwich has to be able to maintain our capital spending and our infrastructure. We have, obviously, we could argue all day long, we have more amenities in town than some. We have from nursing homes to golf course to ferry boat services to parks and neighborhoods. We have a lot of different things that we enjoy and we choose to fund them. So it's just, I think, the debate can, obviously, it's been going on with this debate's been about 3 or 4 years now. It could probably go on for another 30, but I'm just,
Mr. Chairman.
Mr. Norton?
Yes, a reference was just made to the debt refunding issue and the necessity of the present value savings. Any debt refunding and actually any funding process has to address the issue of the yield curve.
Correct.
And you can't separate one from the other because the yield curve is what really drives whether or not you're going to be refunding. And the yield curve, the longer it is, the more volatile it becomes.
Okay, all right, so the item before you is a Democratic member of the debt fund policy. It is before us, not amended, as submitted. All those in favor?
Aye.
Opposed? Aye. Am I correct? 6? 6, okay. Mr. Drake?
Yes.
I'm going to say it doesn't pass.
It has not, it did not pass.
Not
I'm
passed.
sorry, that was 6-6, Catherine.
On behalf of Ms. Weissler and myself in the working group, I'd like to put before the BET the debt policy, which is also in your package, which is noted to be the Drake-Weissler draft. And,
Do you have, you got to get it moved and seconded.
Sure.
Do I have a
Move
second?
it.
Second.
Seconded by Mr. Norton. The item is before us now. Ms. Weissler, did you raise your,
I have a motion to amend,
okay?
Mr. Chairman, is that?
Go ahead, Ms. Weissler.
All right. If you were to look at the draft on page 2, C, the third bullet, that should read, maintain a maximum town of Greenwich net debt of no more than $245 million, and strike all the rest of the language. So that's a motion to amend. I guess, is there a second?
Motion to amend by Ms. Tarkin, seconded by Mr. Norton. Discussion, Ms. Weissler?
Yes, I just wanted to comment on the Sorry. I wanted to comment on the rationale for this, given that you had a model in your package which would have indicated $278 million. We are looking out over the 2-year time frame, as opposed to looking beyond that, given the volatility and uncertainty with cash flows and projects. Over the past week, Mr. Drake and I spent a considerable amount of time talking with Mr. Menarski and Mr. Rowland to look at refine some of these numbers. I think if you were to look at sort of the refinements, they mainly assume that there would be future additional delays, as we have seen in some projects coming to fruition, and there was also a slight bump in terms of the principal amortization. I don't know if Mr. Menarski wants to comment on additionally on the type of work that we did in terms of refining it.
Discussion. Peter, did you have anything you wanted to say?
Nancy, are you referring to the document that's in the package?
I'm referring to the as we had discussed over the past couple of days, we'd made some refinements over the original maximum debt, which had been $280 million, to bring that and the amendment on the table is to bring that maximum to $245 million, which reflect the conversations that we had over the past few days.
Hopefully I can remember some of them. One of the changes was in the authorized unissued, and in the official statement it refers to an authorized unissued of $43 million. Authorized on issue is basically you authorize X number of dollars for a project, and it's the balance that's not funded, okay? And we come to the BET each June. We went back and analyzed it because that number is audited by the auditors, and what was in that number was, one piece was $4,043,000 for Tuckman. It didn't take into consideration the fact that MISA is going to be reimbursed for about $8 million. We already got $4 million, and I forgot the third piece. There was a third.
Nathaniel Wetherall. Wasn't there $1 million? Yeah.
Either way, it impacted the number by $13 million, and it was one of the numbers that Mr. Drake was using that was going to flow out and be spent. So we took out, with that, looking at that analysis, of at least $13 million that couldn't be bonded. You can't double dip on MISA for like $8 million. Tuckman is going to be closed out next year. It was just an old project that sat around for years that never got closed out. And then there was another one where we recalculated the debt service, and the difference between Roland's model and the actual was understated by $5 million. We had a lower amount that was going to be bonded in the January of 16 by $50 million. The debt service came out to about $5 million.
Debt you have is extremely low. Even if you were to get to 400, even if you were, that would be still far below any other AAA-rated municipality in this state and nationally. We would still be in the highest echelon of top-rated municipalities. The problem, and I just, Mr. Chairman, responding to you, you mentioned that what we have is what somebody has paid for at that time. But the problem is, we make the upfront cost of all of these assets so prohibitively high on taxpayers, current taxpayers, that they don't do it. So we've got an Eastern Greenwich Civic Center that is literally sinking. We've got ferries that are rust buckets. The ice rink is a mess. We have the oldest school facilities of any Gold Coast community. People don't purchase these because it's so expensive up front. And then what we have to do is what we've done now, which is we've got compressors which break down, we've got generators which break down, and we're forced to come up with these emergency appropriations instead of planning prudently and long-term and spending for them long-term. So I think we should have a policy, not try to keep a number that is only relevant for 12 to 18 months from now is just not serving its purpose.
Ms. Tarkington?
Yes, I'd like to make a comment on 2 or 3 different things here that, we've had changes for or that we've retained. Number one, I think that the state's equalized grand list, I think that's a readily attainable number, and if the rating agencies want to use it, that's fine. But in terms of what it is, there's a substantial variability between the town's grand list and the state's equalized grand list. The town has no control over how the state computes this index. It is there, it's the state's black box. At this point, I would prefer not to use this index for computation of the town's debt availability. I think using the town's grand list is one way to do it. But I think once you take it outside the town, we have no control over it. And, I always wonder how it can vary so much and be so different from our own. So I want to make that comment. I think another comment is this debt policy does retain the ratio of annual general fund debt service to no more than 70% of the annual capital tax levy. And when I asked Peter Minarski, what are these numbers? And, is there a reason to increase this by over, some number close to 50%? And he told me that today I guess in January or now, it's about 63%, and it will be going down to 59%. So that's also something that we need to think about. And finally, I think that as we look back to the financial crisis, we've been able to regularly invest in capital assets and capital maintenance precisely because our forefathers did not bond with long-term debt, and that we didn't have that additional debt burden through this period of time, which allowed us to continue to upgrade our own infrastructure when most towns and cities throughout the United States totally pull back. So I think we've all worked together very well in terms of, every year in the budget, and I certainly appreciate all the work that, I'll just go down the line here so I remember, Nancy and Mary Lee and Bill have contributed here. And I think that this has been very useful because we've all had to think through a lot of what we have here and try and come up with a solution that works. So anyway, I thank the four that have worked long and hard on this.
Mr. Norton?
Yes, Mr. Chairman. I'd like to address briefly our debt structure and the reason it's structured this way, because I think it gives us great flexibility. And inherent in that is the difference between the various types of debt financing, which there are basically two. One are general obligation bonds, whose funding is provided actually through our taxing ability, as opposed to revenue bonds, which have been used for Nathaniel Witherell. And there's a substantive distinction between the two of them because a revenue bond is based upon the revenue created by the entity for which the debt is incurred, which is very much distinguished from the debt which is incurred as a result of our ability to tax.
Okay. All right, so I'm going to call this motion the Republican.
No, the amendment.
I'm sorry. On the Ms. Weissler's amendment. All those in favor, signify by saying aye.
Aye.
Opposed?
Nay.
1, 2, 3, 4, 5, 6. That item has carried 7-6. That brings us back to the motion as amended. Republican in your packet. All those in favor signify by saying aye.
Aye.
Opposed?
Nay.
1, 2. That item has carried with the same vote. Okay, thank you, everyone. Moving on. OPEB Trust Board nomination. Now, before we get into this, last month, was it last month? It was last month. It was July. I did the agenda with Elaine, and I put on, because we had a vacancy on the OPEB Trust Board for 5 months, and we had been talking about it, and everybody had been charged with finding a replacement, I put it on the agenda. I was going to just do it from the floor, because with the vacation schedule, I couldn't get on the investment committee. So I left that agenda with Elaine, and Peter, you want to tell him what happened? Peter says we have to nominate the chairman, so he thought that's what I was talking about, and the agenda went out for that purpose. You remember the chairman of OPEB?
What we do normally every single year around July, and it goes through IAC, is the chair has to be renominated.
Correct.
Okay, and each of the members has a 3-year term that is staggered, so that each one is coming up. Poor Mr. Skidmore passed away, and even before he passed away, he was scheduled to come off because he moved out of town.
Right.
So I think the disconnect was that I was telling Elaine that we have to re-elect the chairman.
And I was saying we have to fill the vacancy.
We had to fill the vacancy.
They were two different items, and I realized that, and I met Mr. Finger in the hallway, and I go, well, we'll add an item to the agenda, and then the confusion began. So, and we took a vote and everything. I thought that wasn't clean. We needed to do this, and I think it was the next day I sent Mr. Finger an email. I said, well, we're going to put that back on the agenda. So with that said, for my confusion, and obviously when you build agendas, this is what happens. So with that, I'll call on Mr. Drake.
As noted in our report in your package, at the Investment Advisory Committee meeting on September 10th, the committee interviewed Mr. Pellegrino to serve on the OPEB Trust Board for a 3-year term through June 30th of 2018. Mr. Pellegrino is well-known to all of us and has a very vast experience in finance and in investments. And he noted that his first BET assignment was to be the chair of OPEB when it was created way back at the Genesis. He wasn't? Okay, Art's correcting me. Were you the chairman? Sorry. And I apologize.
Now that we've rewritten history.
Mr. Norton was the chairman. Then what was Joe?
Joe succeeded, well, Joe wasn't there at that time. He came on.
Whatever, let's make a
Okay,
motion.
let's.
In any case, the IAC voted 3-1 to approve his nomination and forward it to you tonight.
So on behalf of the Investment Advisory Committee, you're placing Joseph Pellegrino in nomination for a seat on our OPEB Advisory Board. Doesn't require, it's coming from a committee. Okay, discussion on the motion. Okay.
Mr. Chairman, just a clarification.
Please, Mr.
So-
Goldrick.
He's being voted on as chairman as opposed to a member?
No, we voted the chairman in July. That was my confusion. That's what we did in July.
Rob Strickland.
So we did not vote for Mr. Pellegrino?
Well, we did, but
We did.
it was in a confusion thing, so I'm redoing it to affirm it the proper way.
So he's already been confirmed, but this is his second vote on that.
Second attempt. Okay. All those in favor?
Aye.
Opposed?
Yeah, 1.
2. The vote is 10-0. Okay. Item 11, approval of BET minutes. They've been moved and seconded. Discussion? All those in favor?
Aye.
Opposed? Abstaining? Mr. Drake, back from your camping trip, do you have anything for us?
I wanted to talk a little about the parade,
Yes, we have to
if
do
I
that.
can.
Yes.
Thanks to Catherine bringing it to our attention. This Sunday at 2 o'clock, we have the parade for the 375th anniversary of our wonderful town. And we are all invited to march. And I propose to drive my convertible, which has 4 seats. And first come, first served, 2 of the members have already offered to jump in, but
Do I get a seat?
pardon me?
Do I get a seat?
Well, let me continue. Mr. Blankley, being a person of great culture and true class, said, well, Mr. Drake, if you're driving and you got Mr. Norton and me, and we make all the ladies walk, that will just not be satisfactory. So thank you for bailing me out. My wife would have had my head as well as you. So please, for one of the 3 ladies, would you please sit in my car? You can, the 2 of you can drive it if you want.
This is on
Next to you in the
TV.
seat or in the back?
And, no, wherever you please, and the others of us will walk.
I'm walking, thank you very much.
Where's the media when you need them? Okay, so,
Last thing, we're going to meet, we can all march together. I'm really going to try again to surrender my seat. But the idea is to meet in front of, the parade kicks off at 2 o'clock in front of Town Hall. The assembly time is basically 1 in front of Town Hall. You'll see my convertible with a little sticker on the side that says Board of Estimates, so they know who we are. Please come join us.
if I can interrupt your report. Yeah. Catherine, tell us what else you want us to do, when you want us to do it, and how you want us to do it.
It's 1:30, the BB's email.
Cool.
I was asked to give them to,
Send the email.
first of all, the BET, and I have 4 flags for the BET. And then I am carrying another 8 flags, 4 for the RTC and 4 for the DTC. So depending on who's not going for the BET, I'd like to give the DTC and the RTC flags.
If you give me the flags for the DTC, I don't know if they're still meeting, but they're meeting upstairs. I'll see that they get the.
Thank you.
Okay.
Are you going?
Well, they're going to gather in front. I'd be happy to deliver the flags to them.
Oh, no, I was wondering, yes, of course they're going to gather.
Yeah, so I'm happy to give the flags. I mean, but I don't plan, I plan to
And
march with the
ours,
BET.
you might as well put them in your car, so we have
That'd
them
be
there.
great.
Okay, so who's marching?
I'm sorry, who's marching?
Who's going to attend on behalf of the BET?
That looked like,
10 or 11 of us, right? Okay,
who's
so.
not?
Okay.
It looks like 12.
Oh, okay, so we're all going to be there. Okay, that's good. Thank you very much. Anything else, Kathy?
I guess the only thing is, we've been working very hard on audience development, and we find that it would appear that the Cub Scouts who are going to be passing out little flags are now marching as opposed to passing out.
So there'll be nobody watching, everybody's going to be marching?
Yeah, are there going to be any observers of
Little
this?
flags, and then the American flags that several different people contributed to donate, are going to be passed out by other people, and I'm trying to put together some people who would cover one side of the Greenwich Avenue for two blocks, and then, so I was looking for and have found 6 of the 8 people that I need. So if anybody knows somebody else who is not marching, who would like to spend an hour passing out flags, because we'd like to greet the whole parade as it comes and it begins down Greenwich Avenue. So I'm looking for 2 people, but not necessarily for this group, but if you know somebody else who
Okay.
would like to.
So we need some volunteers.
Is it smart for us to be talking about assembling out in front of Town Hall? We're going to be blocking traffic. Shouldn't we be assembling on one of the parking?
I think this road is going to be
That's where
clused.
the parade kickoff is.
I think
the road will be closed.
I think the road's
It'll be
closed.
closed. Stick with me, I'll get you in.
Lucky me.
Okay.
There are 5 assembly points, but yes, you all are here in the first assembly point.
Got it. We heard the other night at the RTM that we're first, second, third, fourth, something like that. So we're fairly early in this, so. Okay, Mr. Norton?
No. Even we met for 3 hours, no, sir.
Okay, I don't have much. I did attend the Harbor Management Commission meeting. Mr. Raymer was in the audience for a little while. Peter Minarski went with me on that. Obviously, they're getting ready with their harbor management plan. They're probably going to need an interim appropriation from that RRR fund, et cetera. Expect that. That'll go to Budget Committee and go accordingly. Been invited to is it the Round Hill Association about the Northwest Association or Round Hill for the new assessments that are coming out, and I think Ms. Kiernan and I were invited to go to that, and Lauren's going to go with us. So that's coming up. I'm meeting with the League of Women Voters for that long survey they're doing about the RTM. I don't know if anybody else was contacted about that. They have a series of questions, so that I have coming up. And I look forward to the special calendar for the Budget Committee, and that's all I have. Ms. Weissler?
Make a motion to adjourn?
All those in favor? Aye. Opposed?